for them not to bet against the pound. Is that really true? Is that being borne out? What does that mean in terms of A, the bank's willingness to do that, and B, the desperation in an administration that has previously said the markets will do what they do?
To be fair, that has been denied. But test balloons often get floated, Lisa. And I wouldn't like to necessarily suggest that that wasn't the case at this point. There have been a number of headlines over the last few days. A number of British papers have been running them, and they have been kind of pointing the finger at the city. Crispin O'Day has come under significant criticism for betting against the pound. The UK has a long memory of George Soros and the chaos that was caused by the exit from the ERM, and the kind of the history is fairly fresh given the recent anniversary of that event. If these are disorderly markets, then you could point the finger and say we need to stabilize them by any means necessary. The moment I think we're struggling to figure out how you do that with, as John says, the backdrop of this incredibly strong dollar and this incredibly hawkish Federal Reserve.
Hey, Guy, no doubt we'll catch up a few times this morning. Good to see you, buddy. Guy Johnson out of London. What a moment. At least I'm not here to say we shouldn't have a conversation about the UK. We should. I said that at the top of the programme. I just think for us all to sit here and make it just about the UK with what's happening worldwide in global markets, that's not where the systemic risk lies.
And that's the reason, I mean, and even if you take a look at the U.S. Treasury response to the United Kingdom and the fact that we've heard Fed officials point the finger at the UK for the trigger as to some of this volatility.
It's nuts.
There is a bigger story here. It is dollar strengthening. It is persistent. It is going to lead to more intervention, as you pointed out. Where is the next node of intervention? Does that come in the form of buying, or does that come in the form of selling treasuries?
It comes under the umbrella of disorderly market moves.
Not according to Yellen.
I wonder how long they're going to be in this market. Yields are lower by 5 basis points on a 10-year. We had a little look at 4%. Now we're back to 3.89 in the US. Futures now unchanged. They were deeply negative. This bond market makes a turn. I guess the question we've got to ask is, will it stick? From New York, this is Bloomberg.
When you think of cutting-edge technology at sea, you might be thinking of stuff like this. But there's an incoming revolution on the high seas that isn't quite as sexy, but could be significantly more impactful.
Container shipping is the key component of global trade. About 80 or 90% of all the world's goods are transported at sea at some point.
But there's a significant unseen cost to the modern era of global commerce.
About 3% of all the world's CO2 emissions come from shipping.
3% may not sound like a lot, but that's roughly comparable to the entire CO2 output of Germany. Since reducing trade isn't a likely option, what about a technological improvement to help reduce the emissions from these well-stocked maritime behemoths?
A lot's happening on Wall Street.
I think Jay Powell said things that were indefensible.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights
We think that's the next secular shift.
from businesses most influential and instrumental.
It's knocking it out of the ballpark.
It's a challenging dynamic.
This is a level of uncertainty that we haven't had to deal with.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio.
When you've had your fill of IPOs, ETFs, and CPI,
tune into the lineup for some NFL, NBA, and MLB. Did you retire too early? I mean, look at some of these payouts.
I absolutely retired too early.
For the inside scoop on sports betting, catch the lineup right here on Bloomberg.
Live from New York City this morning. What a morning already. Equities were down and down hard. Now they're negative just 0.2% on the S&P. On the Nasdaq, we're down 0.5%. Cannot keep up here at all. Check out the bond market, through 4%. We were going back to highs we haven't seen on a 10-year yield before 2010. Back to 08, 07 across the curve. 388 now. Yields lower by 5 or 6 basis points. The turnaround comes from this market right here, off the back of a Bank of England announcement of a gilt market operation to come in and temporarily, over a limited time, buy long bonds. The 30-year dropping by 62 basis points on a UK 30-year today, Tom. The yield now, 4.36.
Let's stay on this before we get to Lindsay Pieggs on the impact here, particularly in Washington. But, John, I'm really going to go with what the Telegraph is saying right now. This is just flat-out intervention, and maybe, as Jens Nordvig said, an original intervention to what Krugman said in the New York Times, John. Ambrose Evans Pritchard Publishing, Liz Truss must choose between a fiscal U-turn and a housing crash. We just got the U-turn.
Well, I wonder if we have had the complete U-turn.
No, I agree.
Tom, this is the intervention that addresses some of the dysfunction or the disorderly nature of the market moves we've seen in the eyes of the Bank of England. I don't think it addresses the underlying problems, Lisa, and for that, we need to work out whether the Bank of England is going to step up and validate market pricing for rates into the November meeting, and we need to understand how far the fiscal issues are going to go.
Which is the reason why Guy Johnson is absolutely correct when he says, watch the pound, and the pound is lower on the day. The pound is at a new post-1985 low, and that is the reason why, not on an intraday basis, it's at 106.67, just if it were to close there on a closing basis. How much are we looking at that being the pressure valve at a time where there isn't faith that the Bank of England can follow through, and also there isn't faith that these policymakers are going to back away from certain policies that have been called out by the IMF, which I'm sure you have things to say about.
Is it any surprise, and before we get into the IMF, and I can talk about that later.
I'm sure you will.
Is it any surprise that we've had some sloppy issues this week, auctions in the primary market, etc.? I think it is, given the scale of the moves that we're seeing in the bond market. It's not just about the fundamentals, it's how big the moves are on things like a 30-year gilt should not be moving 60 basis points on any given day.
So just for background, there was a 2-year and a 5-year auction so far this week. They both were terrible. The 2-year was less bad than the 5-year, which was pretty bad, and today there's a 7-year auction. There is a theory out there that the buyers, the biggest buyers, are stepping away. The Japanese government selling treasuries in order to support the yen. You've got the U.S. Treasury, or the U.S. Federal Reserve, which is actually letting its balance sheet roll off at an accelerated pace this week. How much does that take away some of the conviction, John, that you had from investors who see value? They see real yield, but they're still not stepping in big enough numbers to stave off these declines.
I can't imagine, Tom, how tough the scenes are on the trading floors of the City of London right now.
I know.
Whipsawed.
I can't fathom. You know, you talk about VAR and all the fancy analysis out the window. Here's what we're going to do, and this is very important to go from London to the challenges, say, in Seoul, Korea, maybe the Philippines, moving up near 60 pesos per dollar. How about Washington? Lindsay Pieggs, that joins us now, chief economist at Stifel. Dr. Pieggs, it's wonderful to have you with us today and so timely. I want to talk about the central banker of the world, Jerome Powell, and the real yield. We have come so far so fast. I measure a moving average of the real yield in normal times, 2.05%. We're not almost there, but we're getting there quickly. Have the cards changed? Has the dialogue changed? Has the math changed for Jerome Powell? Because the real yield with London and everything else has moved so far so fast.
I don't think the storyline has changed quite yet. As we heard from the chairman himself, we're only at the beginning of the tightening cycle. We're at the very low level of what he considers to be a restrictive policy. And based on where we're seeing inflation in the economy, there is still quite a ways to go. Now, no doubt we are seeing dysfunction in the markets overseas, but at this point, the Fed is primarily focused on those inflation figures. And on Friday, it's likely that we do see an uptick in core PCE, which will keep pressure on policymakers to stay the course and reiterate that message. Regardless of the dysfunction, they will continue to raise rates.
Okay, well said. Do you look at their path? Is a la Bullard a massive front load right now, or do you see it as linear or curvilinear out into 2023?
Well, let's take the Fed at their word. And they were very clear that they did want to front load a lot of this tightening into the market in order to catch up with the curve. Remember, there was a lot of criticism that the Fed was behind the curve. They maintained that transitory language for too long. And as a result, they did need to accelerate that rate path that they would have otherwise been on had they initiated a remove of crisis level policy earlier, maybe as early as the end of 2021. So I do think there has been a very clear acknowledgement. They were trying to front load. But again, when we look out to the Fed's expectations, the forecast put out last week, there's a good number of committee members that say we're going to stay at this accelerated rate path, with some anticipating a fourth round 75 basis point increase when the Fed again meets in November.
John, what's that do to India?
What does it do to everyone else, Tom?
Yeah.
Right now, the global pain is phenomenal. Lisa, that's where the UK comes into it. Lisa, you know that meme of that individual in that burning room and the fire is playing out around them and they're saying everything is fine and they're having a cup of coffee or something?
Yeah.
For the UK's a cup of coffee. It's boiling hot and they're like, oh, this is too hot, it's scalding, we've got a problem. But the bigger problem is the flames all around them. And the way we're talking about the UK this morning is, yes, the UK has massive problems. We've highlighted them. In fact, we had a debate about them before ahead of time about what could happen here in the gilt market and in sterling, and it's materialized. But the bigger issues is 300 basis points of tightening in just 6 months, throwing QT on top of that, a dollar absolutely surging, and a global economy that has whipsawed from having the White House absolutely juice the economy in 2021 and the Federal Reserve in 2022 slamming on the brakes. They're the flames in the global economy right now. Not a mug of hot tea or coffee, whatever your choice is, and what's playing out in the UK.
Well, or Zero Hedge just put it out on Twitter, one of the most supposedly most stable instruments in the world is up 14% this morning, to give you a sense of just sort of the penny stock nature of some of the most full faith and credit kinds of markets. The bigger issue for me at this moment, there are the policy considerations, where to point the fingers, where to point the focus. For right now, from a market stability standpoint, what does it do, John, when you get suddenly a 14% move in what's known as a stable instrument? What happens when you get this kind of violent volatility in full faith and credit around the world? At what point does something break?
Lindsay, do you think that the Federal Reserve looks at these issues and says, well, that's the UK's problem, it's the Treasury's problem, the government can do something about that? Do they look at the BOJ and say, well, you're doing yield curve control in a rising interest rate environment, this is your problem, you can do something about that? When does it become, Lindsay, the Fed's problem?
Well, I think right now, when the Fed is making policy, they are primarily focused on what's happening in the domestic market. That being said, they certainly can't make monetary policy in a vacuum. They are aware of what's happening. And it's not to say the Fed is entirely to blame for the market volatility that we've seen. Obviously, the UK budget proposal was a big factor. But when we talk about the extreme policy accommodation removal that we've seen, this has caused significant shockwaves in the market. And as the bellwether for the global marketplace, of course, then we would expect shockwaves to fall out throughout the global marketplace. So the Fed was aware and is aware of the contagion effect of monetary policy. But again, that won't be enough to deter this Federal Reserve from their current pathway, as their focus is reining in inflation and reinstating the bedrock of the economy, which is price stability.
What counts, Lindsay, as market dysfunction right now?
I think the incredibly large moves that we're seeing on a day-to-day basis, when you're talking about global markets moving 20, 30, 50 basis points off of one data point or one policy announcement, I think that in and of itself is an indication of dysfunction, uncertainty, extreme volatility. And I do think that the Fed is very aware of how quickly the tables can turn. So again, when we talk about monetary policy and fiscal policy ill-aligned overseas, that can quickly become the case back here at home. As we do have a very important November election coming up, I think the Fed, again, has more than enough reason to try and front load so that we don't find ourselves in a similar situation if we do see policymakers move in a more supportive position, given the fact that the U.S. economy is far from robust at this point.
Rock in a hard place right now, that's for sure. Lindsay, thank you. Lindsay Piegza there of Stifel. So we've got a 69 basis point move on a UK 30-year, so we're back to 429. I can tell you that's where we were at the open on Tuesday morning, which, Lisa, was yesterday.
So when do trading desks start to blow up? When do we start to get some sort of systemic problem? At what point do these moves start to trigger some sort of systemic problem? I don't know the answer to this. None of us do. There has been some questions of why we haven't gotten an event in credit markets, why we haven't seen more forced selling. This is going to be an increasing point of focus, John. We know the White House is looking into market volatility.
They're looking at it.
Yeah, they're looking at it.
I think Tom was right, and Tom, you are right to pick up on the potential of a housing issue in the United Kingdom. Given how much house prices have surged over the last couple of years, the fact that you're going to have rates move as quickly as they might have to move, Tom, if we do validate market pricing over at the Bank of England, and the fact that so much of the mortgage market is priced off where bank rate actually is, where the bank rate at the Bank of England turns out to be.
Two things quickly here. I did a mortgage calculation off of 3.10% spiking up to 7%, John, and basically you can buy 25% less house this morning in America from the joy of a number of months ago. John, help me here as The Guardian writes about the 1922 committee. These are the conservatives that I guess if they get upset with Truss, am I right that they could throw her out the door of 10 Downing Street?
They can put some real pressure on her, yeah, Tom. They can push her to maybe think about resigning. They can have that vote if they want to further down the line. I do wonder if the limited nature of this central bank intervention is left that way, Tom, to give the government the opportunity to do something on their side.
Well, we need to clarify that, John, for people that don't, you know, their heads are spinning. Folks, our heads are spinning, and we're supposed to know what we're talking about. John, the bottom line is this is a central bank intervention today,
and it is
not
limited.
The government.
It is limited. The auctions will take place from today until the 14th of October.
What'd you call it? QC? I think that's pretty good.
Confusion.
Yeah, I think that's probably an evergreen
I owe that one to my old producer, Ollie Crook, but I'm going to run with it anyway, because that's what teams do, right? You know?
Go team.
Go team.
Here it is. I take credit.
Futures unchanged on the S&P. What a turnaround this morning. Yields much lower too. We're down 5 or 6 basis points. We were at 4% when we started this program on a 10-year. We're back to 388 in America. Alan Ruskin at Deutsche Bank is coming up shortly. Looking forward to that. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Hurricane Ian has now become a dangerous Category 4 storm as it roars towards southwestern Florida. It has maximum winds of 140 miles an hour and is expected to bring heavy rains and potentially deadly storm surge when it comes ashore late today. More than 2 million people have been urged to evacuate. According to one estimate, Ian could cause $45 billion in damage and economic losses. That would make it one of the costliest storms ever in the U.S. In the UK, inflation in shops set a record this month. The British Retail Consortium said shop price inflation accelerated to 5.7% in September. That group says that retailers are battling the weak pound, rising energy bills and commodity prices, and a tight labor market. Wall Street has been hit with more than $2 billion of fines in what's become called the WhatsApp investigation. Regulators reached settlements with a dozen banks for failing to monitor employees' communications on unauthorized messaging apps. Goldman Sachs, Bank of America, Citigroup, they were all among those that were penalized. Elon Musk has asked a federal appeals court to throw out his so-called Twitter sitter deal. Now, that's the 2018 agreement with the SEC that requires a Tesla lawyer to screen all of his company-related tweets. In a court filing, Musk lawyers call it a government-imposed muzzle on Musk's speech. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
brainchild of Apollo CEO Mark Rowan. In January, Apollo closed its $11 billion all-stock merger with Athene Holding. It had already owned 35% of the insurer. Here's what Apollo gets out of the deal. Assets under management. Apollo expects them to double to about $1 trillion by 2026. Much of that projected growth will come from the merger, and those assets are especially attractive to Apollo. Insurance companies typically go after much more modest returns than buyout investors. That will give Apollo more options for investing the cash. Athene is a steady provider of fee income. It has grown into one of the nation's biggest holders of fixed annuities, those retirement savings products favored by risk-averse customers. The merger will also allow Apollo to simplify its governance. It gave up its dual-class share structure and adopted a one-share, one-vote plan. The hope is that will eventually lead to Apollo's inclusion in the S&P 500.
Markets are preparing to close, but the day is not over yet.
Stock that is now up about 45%.
A lot of volatility right now.
You need the power of the Bloomberg terminal to get you market-moving data before anyone else.
These numbers are much higher than expected.
Upgraded today to overweight.
You need top analysts to bring you exclusive global insight into cross-asset markets.
The muni bond market.
China is a really big focus.
Bitcoin ain't playing along today.
It's going to be short-term.
Bloomberg Markets, The Close. Weekdays on Bloomberg.
From New York City.
We're in London, in Sydney, in San Francisco.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching. You do not want to miss this story.
How are you thinking about those dynamics?
Nutrigenomics and precision nutrition is one of those rare scientific fields that overlaps with the Instagram-friendly wellness industry.
There is a lot of interest in this idea of personalized nutrition and especially how accessible it is to the public. You can go on Google and type personalized nutrition or diet and genes, and you will find dozens of different companies that offer this nutrition precision tests.
One of those companies is Routine. Routine claims that their personalized tests stemming from sciences like nutrigenomics make their supplements different. But even with the claims from Routine, as well as dozens of other personalized nutrition companies, the science still has a long way to go.
balance that off with our dual mandate with full employment and trying to navigate that to bring inflation down while we do so as gently as possible, not to tip unnecessarily the economy into a downturn that actually influences the full employment part of our mandate is a struggle.
Mary Daly there, the San Francisco Fed president, live from New York. This is Bloomberg. Here's the price action. Equities lower by just 0.2% on the S&P. On the Nasdaq 100, down 0.6%. It was worse a little bit earlier. Yields were through 4% on a 10-year. They're now down 4 basis points to 3.90 off the back of this mess in the UK. Yields are lower on a 30-year by 65 basis points. Potentially history in the making here, because if we finish this low, have a move this large, it's the biggest move lower in history off the back of a Bank of England that came out just an hour ago and announced gilt market operations, Tom, to bring yields lower and to buy the long bond in a limited manner.
Yeah, excuse me, John, I didn't mean to cut you off there.
Sure.
We're here on radio and television, of course, a most historic week and day, and we'll continue our coverage here of the international economics in turmoil. There's no question about that. Anywhere to go, we have to slide in here a story that broke last night. Edward Ludlow's here from San Francisco in New York and briefs us now on the travails of Cupertino. How serious is this? Is that there's an Apple iPhone, it's not selling all that?
I mean, you look at the pre-market Apple trading and the puke in futures last night, which carried over to this morning. It's serious. We look to the smartphone market as almost a leading indicator for what's to come in the economy, right? Rich people buy iPhones. Enterprise fares better in a recession than the consumer. But we're starting to see signs now that actually Apple's hopes of growth in those expensive products aren't what they brief suppliers they would be.
We've been here before. I remember standing on Fifth Avenue with Larry Haverty, the giant of this years ago, and we were laughing about how every 4 years Apple's going to die. Is that where we are again?
It's not going to die because all they're doing is U-turning on updated expectations, right? 90 million smartphone units this year is what they've instructed their suppliers, according to sources. They briefly hope to boost that by 6 million units. 90 million is the same as we did last year. It's just not the mega double digits growth of what we've become accustomed to, particularly over the pandemic era. We're looking at 2% sales growth on flat unit growth for Apple. All things considered in this environment, that's not a bad thing. And you look at the sell side reaction, they're saying, hey, we saw this coming.
Well, Ed, how much is this an international story? We've been talking all morning about some of the international pain, about what's happening in Europe, what's happening in Asia, and how it's being affected by the U.S. Ana Agrana of Bloomberg Intelligence said, we continue to believe that weak demand from Europe and China could hurt overall iPhone sales in fiscal 2023 as they account for 43% of total sales. How much is this the beginning of a growing swath of downgrades to estimates and production because of global weakness?
Yeah, I mean, China's really key to that story because Apple has 20% sales exposure in the region, right? And that is a key region where there is evidence that the smartphone and consumer electronics market is slowing down. You know, we've kind of gone off the rails of talking about how China is our crystal ball into the health of high growth companies like Apple, but it's key in Europe as well. You know, the problem with the iPhone 14 launch is that they launched models that ranged in price. And according to sources, the consumer is expecting or is showing evidence that they're favoring the more expensive model. But it means that those lower price models, which kind of have historically been larger in volume in markets like China and Europe, where pain's being felt for different reasons, right? The inflation story in Europe, China, the economy is kind of all over the place. That is worrying to analysts because they want to see that actually there is enough volume on the higher end to offset the weakness in the lower end of the market.
Ed, it's awesome to have you here in New York City with us. Thanks for being with us. Ed Ludlow there, weighing in on the Apple story. That stock is down by about 3.5% in the pre-market. Lisa, how many times have we had this conversation about Apple and they come out with quarterly earnings and just knock the thing out of the park?
Right. Is this time different? And the interesting thing here, and the reason why this is different, is because they had previously said recently that they were going to increase production. This is an about face. Is there some sort of rapid deterioration akin to what we've seen in FedEx that's affecting other companies? And how much is it really stemming from what we're talking about in Europe and what we're talking about in the United Kingdom?
Should we go back to the UK?
I think we have to. This is the story. I mean, well, I don't mean that. I meant just, the story going back to. I don't think that my kids move on.
106.57. You're taking it back. You don't want to go back. Okay. Cable's now negative 0.7%.
Yeah,
So it's a weaker pound. And Lisa
deal.
was so quick to pick up on this.
Deal.
Yes, we're seeing a big move in the bond market. Yields are lower by 60 basis points on a 30-year in the UK. But sterling hasn't appreciated, Tom. It popped higher. You had a decent pop on cable just briefly and then snapped back lower again.
I think it's very, very complex, John, and I'm sorry, I'm going to go with what I read from others, that the fixed rate mortgage, the floating rate mortgage, rather, is the key social issue here.
Huge problem.
That they're confronting right now. I just want to point out the reason Ed Ludlow's moving to New York is he enjoys the traffic.
Is he moving to New York?
Yeah, he's moving to New York.
I didn't know that.
He enjoys the traffic. But
Congratulations,
John,
Ed.
I don't think he is moving to New York.
Well, it's not the worst thing.
We're going to lunch today. I'm going to try to figure it out. I'm taking him down to McDonald's on 3rd Avenue. You know,
Very
live
kind.
large. John, I'm looking at where we are. Can I just state something? The VIX is at 33.43. We've seen equity deterioration really begin to catch up with the song and dance we've been talking about for 3 days.
We were down by about 1% when the show started on the S&P. We're now down just 0.1% on the NASDAQ. We're down 0.5%.
Because the central bankers are going to blink. That's the theory.
Are they going to really blink? So this is the
not my
intervention,
opinion.
Tom.
I'm just
Are we going to
saying-
get a change in policy, and what does that change in policy look like? Intervention can only do so much for so long. We saw that with dollar yen and the BOJ stepping in. Ultimately, to get something sustainable, Lisa, you need to have a decent picture about how the fundamental policy shift is going to take place. In the UK right now, that remains to be seen.
To put another way, there is a distinction between blinking and having stability. Right now, the lack of stability is giving people real pause about whether to go into risk assets. We saw that from Bank of America yesterday coming out. They had previously liked investment-grade credit. They no longer have that conviction because of the rate volatility. It is very difficult to go in force with any conviction if you don't have conviction about full faith in credit, John.
If you're just tuning in, the Bank of England announcing, was it 53 minutes ago, a gilt market operation to carry out temporary purchases of long-dated UK bonds. Limited in nature, this will go from today until the middle of next month, I believe. And then 2 weeks after that, basically, we're going to hear from the Bank of England with the rate decision. Now, I keep saying the scheduled meeting is early November. Lisa, I say the scheduled meeting because I wonder if they have to have a meeting before that.
The best thing that I've heard all day is QC. Quantitative confusion. This is just all very confusing. The Bank of England trying to come out, throw the Liz Truss administration a bone, saying, you know, there's some good aspects, trying to basically play politics in this good way. The UK Treasury Department coming out saying, we give them their independence, you go crazy, you do what you need to do. The Bank of England coming out with this confusing statement. How does this give the market stability?
We're going to buy and then we're going to sell bonds, and maybe we won't sell bonds, and we're going to hike rates maybe in early November, perhaps before. I'm with you. It's all over the place. But the biggest story here is beyond the UK. We need to think about why the BOJ had to step in, why the Federal Reserve is doing what it's doing. 300 basis points in 6 months and still talking about doing more. They're doing it, they say, to get inflation low. We get that. But the problems evolving worldwide are just bubbling to the surface in a much more profound way over the last couple of weeks. Yields are lower by 2 basis points. Your 10-year 392. Guy Johnson from London is going to join us shortly to break this down. This is Bloomberg.
What are the moonshots at Amazon that are capturing most of your time and attention?
Well, you know, we have a unique way that we look at big new investments. And I'm not sure it's right or wrong. It just happens to be our way. And we ask ourselves when we're considering something 4 questions. We ask, if it's successful, can it be big and move the needle at Amazon? Is it being well served today? Do we have a differentiated approach? And do we have competence there? And if not, can we acquire quickly? If we like the answer to those questions, we'll go pursue it with a single-threaded team that isn't distracted by the rest of the business.
When it comes to the stock, it has fallen significantly. Do you think investors are missing something, or has tech just been overvalued?
I have never tried to predict what the stock's going to do, and any time I've tried to a little bit, I've been wrong. I do really believe that in the short term, the stock market tends to be a voting machine, and in the long term, it tends to be a weighing machine. We have a concept we talk about a lot at Amazon, inputs and outputs, and the ultimate output for a company is share price, and then other big outputs are free cash flow or profit or revenue. You can't really manage the outputs. You have to manage at the input level, and that's where we spend all our time. And so if you do the right things for the business long term, things tend to work out. I think we've had very good returns for investors, and I expect that to be true again.
To the world of business. Balance of Power with David Weston. News, analysis, insight from and about politics power players. Weekdays. This is Bloomberg.
Enjoy the excitement of a night of music at Boston Symphony Hall with BSO Now. Watch brand new Boston Symphony Orchestra performances, behind-the-scenes storytelling, and memorable archival concerts, all from the comfort of home. Use our free 24-hour trial and see why the Boston Globe calls it musically rewarding. And the Berkshire Edge says the orchestra has never played better. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
Strong enough to stay, we will never.
The Fed is finally getting its arms around making monetary policy tight.
I think the market clearly understands what's happening.
We're probably getting closer to a bottom.
Inflation's here to stay. Higher rates are here to stay.
High rates don't mean a bear market.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Here comes the central bank intervention live from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance on TV and radio. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Farrow. Futures down 1/3% on the S&P. TK, this move in the long bond in the UK, we're down 53 basis points on a UK 10-year.
Let's go back 30 years right now. You talk about a 30-year bond, John. This goes back to 1992, what John Major faced with a fractured United Kingdom, but it is global as well. I love what the great Cameron Christ just published moments ago at Bloomberg. Mr. Christ says this was necessary, but probably not sufficient. John, that out of the textbooks about fits the moment.
The Bank of England announcing a gilt market operation, coming in and buying long bonds, Tom, in a limited manner for a limited time. It begs the question what the next policy shift is here, TK. Obviously, big rate hikes expected from the Bank of England. The central bank's blinked. Does the government?
I'm going to call it Wimbledon. They throw the tennis ball over the net to the government, and we'll have to see what the trust government does here. John, you're way more familiar with this than any of us are, but this is the independence of a central bank, and now what for a government that affected what many call Reaganomics too.
The bonds are surging. Sterling isn't. Lisa, you picked up on this quickly. 106.53. Had the initial pop, then we snapped back lower. We're negative 0.75%.
A lack of conviction that the Bank of England will actually follow through on tighter policy to counteract looser fiscal policy. This really raises an issue, though, because if you end up with, let's say, a 100 basis point rate hike by the Bank of England, right, then basically they're pushing and pulling at the same time. They're going to be trying to lower rates on the long end while still hiking rates on the short end and basically tying themselves into knots, which raises a question, what happens when market pricing is inconvenient? Do you just squelch it? Has that become the new policy?
The policy's in conflict domestically in the UK. It's in conflict globally around the world between the Federal Reserve, the Bank of England, the ECB, and the BOJ, Lisa, in a big way.
And that's the reason why you have these pressure points that are coming out in unpredictable and volatile ways, like the Treasury sell-off that we saw accelerate yesterday, hitting that 4% level for the first time going back 2 decades almost. The idea here in the U.S. of what happens when Japan tries to control its currency and then has to sell treasuries in order to do that. I mean, this is a confusing and very volatile market.
Sterling now down 1%, 106.27. Guy Johnson's going to be joining us shortly. Looking forward to that. Right now, here's your wrap of the markets. We're down 1/3 of 1% on the S&P. We're off the lows of the session. We were unchanged briefly, then snapped lower again. On the Nasdaq, we're down 0.8 of 1%. Yields turning around in a monster way in the UK, in the US as well. Briefly, we were through 4%. Now we're back down to 392.90. Yields are lower by a couple of basis points there. Euro dollar still 95.66. Still some weakness there too. Lisa, euro dollar negative 1/3 of 1%.
And we haven't even talked about Nord Stream 1 and the potential sabotage that we heard accused of yesterday. We will get to that eventually. So with all of this, we have the room with flames, and we have the Bank of England sipping on its tea, as Tom put out there, as John put out there, I should say. And so today, perhaps it's the fire. The Fed speakers, they continue to come out and give some conversation about where they're thinking and perhaps how they view the overseas turmoil. Atlanta Fed President Raphael Bostic, St. Louis Fed President James Bullard, Fed Chair Jay Powell, Fed Governor Michelle Bowman, Richmond Fed President Thomas Barkin. I can't even get it out there, just so many of them. It's just like Chicago Fed President Charlie Evans. Who's next, right? I mean, the parade of people coming out. What can they say at a time when they have to fight inflation and their policies are exacerbating turmoil that is erupting around the world? We also get today potentially a meeting between British Chancellor Kwasi Kwarteng and Wall Street executives. We talked about what potentially could be rumored to be discussed, but this meeting will occur reportedly with Bank of America, Citigroup, JP Morgan, and Morgan Stanley. What's the message? How do you involve people in a market that is doing its own thing when they say the market will do what they do, and then they come out on the other side and they're trying to engage with some sort of policy that relies on market pricing, that relies in inflationary inputs like the value of a currency? And at 1 p.m., really important to watch, John, the U.S. is selling 7-year debt. And these auctions have been messy. There was one messy auction after another. Is this enough yield to get people involved? Is there enough conviction at a time when you get whipsawing yields at levels that we have not seen before of volatility? Is there enough conviction to come in and buy with yields north of 4% on a 7-year?
You get slapped around by bond market volatility the moment you touch the stuff, which has contributed to the nervousness around these issues, I'm sure. Lisa, thank you. Guy Johnson in the City of London. Wasn't expected to start his day this early. He joins us right now. Guy, usually on TV and radio a little bit later. Guy, let's start here. In a moment where we expected the Bank of England to step up and rate hikes, they're buying bonds. Guy, make sense of it all for us.
I'm struggling to see what this has fixed, John. Other than sorting out the pension funds, this is a real struggle to see what has actually been achieved here. So as you've been pointing out, Lisa's been pointing out, the pound is down. We're now trading on the cable rate at 105.91. If you take a look at 2, 3, 5-year swaps, which is what mortgages are priced off, they've barely budged. So the impact into the mortgage market is not changing here. So the pension funds, which carry long duration debt, are the ones that are going to benefit from this. But even there, we're only back to where we were at the beginning of yesterday, John. So yes, we are getting a monster move, but it comes on the other side of a symmetrical move that we've seen. So that chart says it all. Look at what is happening here. Actually, that's just the 2-year. But what we're seeing here is basically just a reversal from yesterday's position, and it's incredible to watch. The currency is down, John. So let's just run through the mechanics of this briefly, if we can. Wow. This is an FPC decision, not an MPC decision. Effectively, it's a recommendation. So this is stability, financial stability that they're effectively trying to deal with here. So it's not a monetary decision, which comes later. That's what we need to talk about in terms of the rate hikes. Tom, they're doing it to try and stabilize the market, but they're having very little effect. They're creating reserves. They're doing this out of reserves, but they're creating reserves. So this is different to this is different to QE, but it's so nuanced, Tom, that I'm really struggling to see what the difference is.
And the headline 10 minutes ago on reserves, it's a complete mystery to me, folks. Critically here, and we just showed that on radio, it is a spike down. Sterling going back to new weakness, 105.87, back to a 104 would be unimaginable. Guy, I just framed out the Bloomberg Financial Conditions Index, which is acclaimed worldwide. Thank you to the great Michael Rosenberg for that. And UK BFCI has moved +5 and then swung -5 standard deviations. It is a 10 standard deviation move. Guy, that is absolutely original in financial history. What is the next step for the Prime Minister?
The next step for the Prime Minister and the Chancellor, I think, is a really difficult one. Do they take the IMF's advice and recalibrate? I doubt it. Do we get further announcements that will stabilize the situation in terms of maybe tweaking a few things? That is possible. I don't know exactly what they are, but maybe there are tweaks that can be made here that maybe make the situation a little bit more stable. Maybe they talk about cost cuts that could potentially come in government departments. I don't know, but there is definitely the necessity for that. The Bank of England has basically, as you say, hit the tennis ball to the other side of the court and said it's back in your court. But ultimately, Tom, we still find ourselves in a situation where the market wants more. The market wants rate hikes here. They want a monetary decision, not a financial policy stability decision. That's what this is. This is a holding action. This is nothing more than a holding action. Rates are going to have to go higher. That is the message loud and clear from this market. The Bank of England is still on the hook for that. When that comes remains to be seen. Can they wait for November?
Guy,
that is an open question.
What was the reaction among policymakers to the IMF statement yesterday?
The UK has a mixed relationship with the IMF in terms of its forecasts and its statements. I think we've obviously had bailouts in the long distant past, so there is obviously that. There was a very long period where the IMF was issuing forecasts about the UK economy that were way off base, so the credibility went down a little bit. I think it was unwelcome, I think probably is the way that I would put it. We have a problem to resolve here. The IMF's intervention, the IMF making these kinds of comments at such a difficult moment, I think is probably unwelcome. But clearly, the market message is the one that everybody's listening to here. The IMF is just duplicating the message that is coming through from the market. Something needs to change. This doesn't fit. How are you going to fix it? The Bank of England and the Treasury have both got a huge challenge here.
Elisa, this is why Guy and I used to host the show together, because Guy was the diplomatic one.
Evidently.
And someone needed to be diplomatic. Guy, it's good to see you, buddy, as always. Guy Johnson, out of London. The ball is in their court. I think Tom has framed it perfectly. And Guy said the same thing. It's limited in nature. The time is going to go out to the middle of October. Tom, and between then, the pressure's going to start building between then and the next Bank of England meeting again on November 3rd. And the pressure's going to build on the government as well. Yield to lower by 52 basis points on a UK 30-year.
You hear me say this cliche, it's a litmus paper of the system, and I'm sorry, sterling is an exceptionally deep market off desks worldwide, and I'm stunned, John, to see the deterioration in the last 10 minutes. I mean, this bodes ill for this government as they try to get to the afternoon in London. I
remember, maybe was it 8-9 years ago, Tom, when Blanchard over at the IMF locked horns with Osborne, the former Chancellor, on austerity. There was too much austerity. They wanted him to back off from austerity, and now they want this Chancellor to back off from tax cuts and spending.
This is a really important
10 years later.
This is a really important observation, John. You killed it there. And the answer here is Professor Blanchard and others, including Adam Posen, are really adamant that this idea of getting back to 2% and the classic Fed model, a la Dudley and others, is just naive as all get out. John, Adam Posen last night with the most fiery tweet of his distinguished career with the Bank of England. I don't know if we can bring that up in time here, but I'm sorry, Adam Posen absolutely on fire last night. No
His
question
line,
about that.
in short, anyone know what the urgent global systemic risk is from UK folly? I don't. He called it bizarre. I called it utterly bizarre. For the IMF to weigh in on this and not weigh in on what the Federal Reserve is up to here in the United States. Coming up, Sarah Malik of Nuveen. Looking forward to that. Futures lower 6/10s from New York. This is Bloomberg.
Keeping you up to date with news from around the world with the First Word, I'm Lisa Mateo. What is expected to be one of the costliest storms in U.S. history is taking aim at Florida's southwest coast. Earlier today, Hurricane Ian was upgraded to a dangerous Category 4 storm with maximum winds of 140 miles an hour. It's now projected to come ashore late today. The hurricane is threatening to bring deadly 6-foot storm surges into Tampa Bay. More than 2 million Floridians have been told to evacuate. One estimate calls for damages and economic losses in the area to exceed $45 billion. In Russia, the Kremlin has declared victory in a series of UN-condemned referendums in Ukraine. Voters in 4 regions occupied by Russian troops have voted to become part of Russia. Moscow ordered the votes after its forces suffered their worst defeats to Ukraine's military since the start of the war. The CEO of Deutsche Bank is predicting a severe downturn in Europe and continued whipsawing in financial markets. Christian Saving spoke to Bloomberg TV.
The volatility will go on, will continue, will stay with us. If you look at the inflation numbers in Europe, if you look at the interest rates going up, I can't see actually that the volatility goes away over the next 12 months.
Saving says if inflation can be placed under control, he sees a good chance of recovery after a year. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
Nurturing also can come from men, and it's one of the qualities, I guess, that you found in your mentors that also pushed you up. Do we need even more nurturing post-pandemic? Is the way that we talk with employees going to change?
I think talent becomes the single biggest differentiator of a successful entity versus an unsuccessful entity. So you've got to do everything possible to hire, train, retain, put your arms around talent. I mean, you've really got to focus on your talent. In the past, it's always been give them money, show them that they have an upward mobility and can make even more money, and that's the only reason people come to work. I think post-pandemic, we're seeing more and more people say, I have to worry about me as a person, I have to worry about my family, I want to worry about my well-being, my mental health. So we've got to start encompassing people as holistic humans as opposed to a tool of the trade, which means that we have to engage with them head, heart, and hands, not just head and hands. The heart has to be engaged. So we have to show more empathy, show that we care, that they're citizens of the community, they're members of the family, and all of those have to come into consideration as we help an executive or an employee be an employee and be a person of the community and the family. The stakes are higher.
The difference between missed opportunity and actionable intelligence. For in-house attorneys who strive to provide superior counsel and strategic advice, Bloomberg Law offers an unmatched platform of analytics tools and business intelligence. All to help improve productivity, mitigate risk, and inform decision-making. For the comprehensive platform that helps you work smarter and faster, the difference is Bloomberg Law.
When you've had your fill of IPOs, ETFs, and CPI,
tune into the lineup for some NFL, NBA, and MLB. Did you retire too early? I mean, look at some of these payouts.
I absolutely retired too early.
For the inside scoop on sports betting, catch the lineup right here on Bloomberg.
Power, policy, politics, From the White House to the Hill, Bloomberg covers the leaders in legislation.
That was really a tectonic shift for this White House.
The theory of this bill, as I understand it, is there'll be a multiplier effect.
How did Democrats mobilize specifically younger voters?
Bringing you the political news you need to know.
The president has made it very clear that this is a significant focus.
For the intersection of Wall Street and Washington, nobody covers politics like Bloomberg.
From New York City.
You're in London, in Sydney,
In San Francisco.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching. You do not want to miss this
How
story.
are you thinking about those dynamics?
No one covers the world like Bloomberg.
Russia will then absorb these territories. What is NATO's reaction? Italy's Giorgia Meloni wins a clear majority, ushering in the nation's most right-wing government since World War II.
The Fed offers no sign that it is ready to stop tightening.
With unmatched reach and resources from more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
Optimistic that we can navigate through this transition in a way where we come out of this as a country and as an economy in a stronger position than when the pandemic hit. So yeah, at core, I do believe that there's no certainty in any way or no way inevitable that we're going into a downturn.
Brian Deese, the National Economic Council Director at the Economic Club of Washington. I know you'll all have thoughts on that. We can talk about it in just a moment. From New York this morning, good morning. Futures are negative 0.7% on the S&P. On the NASDAQ 100, we're down a little more than 1%, completely whipsawed this morning. Down hard all over again on the NASDAQ. Yield 3.94%, then back lower after a gilt market operation announcement from the Bank of England to come in and buy long bonds over a limited period of time to address what they call disorderly moves, dysfunction, and all of the above. Your 30-year is down 50 basis points to 448. And Tom, as Lisa picked up on very, very quickly, sterling briefly stronger. Cable's now negative 1.5%, Tom. It's 105.73.
Yeah, 105.73 and 104 would be unthinkable. I want to say this, folks, where we have a team killing themselves now to bring you what we've been doing for decades, which is world-class conversation. Dr. Larian will join John Farrow in the 9 o'clock hour. Jens Nordvig with us before. And moments ago, David Blanchflower, formerly with the Bank of England, will join us, I believe, in the next hour. We get very lucky here with Katrina Dudley. She was previously scheduled to talk about Tottenham Spurs, but instead we will talk to her about her true expertise in something I'm as dumb as wood on. John Farrow saved me here with Katrina Dudley of Franklin Mutual on the nuances of the gilt market. I'm clueless.
Well, we can start here. Katrina, fantastic to have you with us. Katrina Dudley there of Franklin Mutual Advisors. Katrina, walk us through the unique character, the unique profile of the gilt market and the required need of this, say, Bank of England to respond to what you think it needs to respond to.
Look, I'm not sure that they actually need to respond to anything here. I mean, they're trying to stabilize a market, but I grew up in an environment where we were told that markets were efficient. And so I understand it's only temporary, but I'm not sure that the BOE is doing the right thing. People are now talking about whether or not this pushes off another rate decision. But let's go back and think about what happened last week when the BOE made that rate decision. There wasn't even consensus within the governors. You had 5 of them for 50, but you actually had 3 for 75, and then one lonely person at 25. So even within the Bank of England, there's not a lot of consensus. And I'm kind of curious whether or not that lack of consensus also, is part of the issue why this statement is for temporary intervention, and it really doesn't seem to have a lot of support.
Katrina, you said you don't know that this was necessary, and we've heard from a host of U.S. policymakers that say they do not see disorderly markets. Volatility, yes. Disorderly, no. What is that distinction when you look around the world to understand disorderly makers need to step in versus a logical response to policy?
Look, volatility just is caused by movements in price. So, the price goes up, the price goes down, and the price is always responding to news. So we've had a lot of news. We've had a lot of news out of various central banks, not just the BOE. So that's causing the volatility. When we have disorderly markets, you're talking about buyer's strikes in particular. So no one coming in. And I don't think you've heard any of that out of the English markets. I think what you're seeing is people are going in and acting rationally. And when people are acting rationally, I don't think you need to have the central bank come in and intervene. And my fear is that through this intervention, I think that the term is kind of quantitative conundrum, because we don't really know what they're trying to do here.
No, it's not. We have a surveillance correction, folks. It's not quantitative conundrum. John, help me here. What is it?
We're calling it quantitative confusion.
It's QC regardless.
Here it is. The Chancellor will meet today with Collective Wall Street. I wish Sir John Templeton was there, of course, with the Franklin Templeton funds. That was many years ago. What should Wall Street listen to from a Chancellor beleaguered?
I think what you're looking for is long-term intentions. That's what we want. That's what we really...
Like a week, a month?
Oh, no, gosh. Long-term in a week, a month is not what we're talking about. We're talking about we'd like to understand what's going to happen over the course of the next year. And that's where the Fed dot plots have been very instrumental in giving stability. You don't necessarily need to agree with what the central bank is doing, but if you understand the direction of travel, as an investor, you can position yourself and you can do the right things knowing where we're heading. And I think that that's what people are looking for. And I think that you can distinguish that from the BOE, where we're not quite sure where they're going.
Exante Data's Jens Nordvig joined us about an hour ago. He just tweeted out the solution to one problem creates another problem. They've stepped into the bond market and sterling's weaker, Katrina, by 1.7% at 105.53. Do you think by addressing the one problem in the gilt market, they consider it one? Do you think they're creating another problem in the FX market?
Look, I think you're seeing that weakness in the gilt market. I think there's two aspects here. First of all, people are thinking that the rate decision in the BOE, that they actually may, they're going to delay that given what they're talking about. The second thing I think is we were talking about, you need to understand the importance of controlling inflation in the UK, because a lot of the UK debt is inflation linked, and that's something that's very different to any other market around the world. So the BOE really needs to keep a hawkish eye on inflation and in controlling inflation, and it's not just in order to generate price stability, it's actually also to control their debt costs.
Well said. Fantastic to have you with us, Katrina. Thank you. Katrina Dudley there of Franklin Mutual Advisors. Sterling against the US dollar, negative 1.7% at 105.49. Yields at the long end on a 30-year down by 50 basis points, Tom, 4.48 on a UK 30-year this morning.
Yeah, and critically, the U.S. 10-year inflation, the real yield, John, comes back. I'm doing John, I'll talk about this in the next break. I'm working on the terminal as hard as I can, but I want to make clear to people we are trading at new lows for sterling, except for that brief spike to 103. Technically, to me, John, 103-ish is a fiction. We are at new lows for sterling after what appears to be a vote by the street of failed something kind of intervention. John, the U.S. real yield comes back to 1.60%. The idea that that could break higher to a higher real yield is stunning if we see that.
I think this is the weekly range. 103.50 at the low, 109 at the high, and somewhere in between at the moment, Lisa, 105.60 on sterling.
The reaction you're seeing right now in the pound is a lack of conviction the Bank of England will follow through with what the market perceives they need to follow through with in order to control inflation and counterbalance some of the recent fiscal policies.
You've got confidence about anything right now? Anything whatsoever?
John, I think we need team coverage in London.
Not in life. I didn't want to get super philosophical about the moment.
John,
let's go there.
30. John,
I need therapy, not you.
Really? I need it too.
Material samples brought back from objects in space can shed light on billions of years of our solar system's history, including details about the origin of life here on Earth.
A piece of an asteroid is a piece of the earliest beginnings of the solar system.
But picking up rocks from the surface of an asteroid or planetary satellite isn't as easy as it sounds. It requires voyages of millions of miles to bodies that have never been seen up close. Probes need to land on surfaces with weak gravitational pulls, where the surface terrain is completely unknown, gather samples, and then make the long trip back. And while behemoths like NASA and SpaceX grab headlines, it's a relatively young space agency. The Japan Aerospace Exploration Agency, better known as JAXA, that is taking the giant leap necessary to bring the mysteries of space back down to Earth.
Somebody says, I want to be, and a person has an impact on society, what would you recommend that somebody do to work their way up?
Well, I think the first thing, you've got to believe in something that you really care about.
From the world of politics to the world of business. Balance of Power with David Weston. News, analysis, insight from and about politics power players. Weekdays, this is Bloomberg.
I think it's fair to say this one's a bit messy. In the last couple of hours, futures down 5 or 6/10% on the S&P 500. On the Nasdaq 100, we're down 1%. That's the first time I've ever been called understated. Ever.
Well, you know, what do you really
Lisa.
think? Do you actually think it's a bit messy?
I think it's fantastically messy.
Here you go, see?
In the bond market, your 10-year in America on a treasury has gone from 4% this morning back down lower to about 393, call it 394. The big turnaround has taken place in the UK. I want to compare what's happened in the gilt market to what's happening with sterling. The Bank of England has announced a limited intervention. They will come in for the next couple of weeks and buy long bonds, a gilt market operation, if you will. We're down 53 basis points off the back of it on a UK 30-year to 445. We're still above where we were yesterday morning on a 30-year. That gives you an idea of the scale of the moves. But it's the fact that sterling's not rallying. Only briefly did it pop, Tom. Cable 105.60-ish. We're negative 1.6% on that currency pair. And that's more sterling weakness, TK, that this Bank of England, when it comes to rate policy, might have to respond to.
For America, waking up to this is not discrete to the United Kingdom. We can see on the Bloomberg terminal, it redounds right over to the United States and frankly, worldwide as well, John.
TK, someone just wrote in on the Bloomberg, there are no good or bad market days. It's all about how you are positioned. And then they wrote dumb corporate bond trader at the end of it. That is from a corporate bond trader, by the way. TK, the people that have been whipsawed by this, yesterday, if you were short a lot of this, great yields were aggressively higher over the last week and then just getting slammed the other way. This is a bit of a messy market.
In the blur of the morning, maybe you brought it up, maybe Lisa brought it up, but you really wonder what we're going to see from bank FIC desks, the reports from banks that we're going to see, because they and we have never seen this. I mean, this is original.
They like volatility, don't they, Bramo? And then they come out in earnings season if they didn't perform and they say it was the wrong kind of volatility.
Yeah.
It's good volatility, bad volatility. We'll find out with bank earnings, and perhaps we'll find out if we get a more recent disruption. Can I just talk about a specific company for a second?
Of course.
Okay.
Original.
So we were talking earlier about Apple, but I want to tie it to the global story because we're talking about international pain. What will the Fed's response be? What will corporate response be in the United States? And looking at Apple shares, they're down. At one point, they were down nearly 4% after the reports came out that they were going to ratchet back plans to increase production of their new iPhone. How much of this has to do with the international story? Europe and China account for 43% of iPhone sales, right? This is according to Bloomberg Intelligence. How much of the lack of demand that surprisingly sprung up comes from some of the pain that we're seeing accelerate in a dramatic fashion? We're also seeing that play out in Taiwan semiconductor industries with those shares lower as well, because we have heard this over and over again, Tom. The demand for chips is coming down. You can see those shares down 3.4% in pre-market trading. How much is this a
a story about specific, perhaps bringing forward of supplies, right? Because people bought so many smartphones and tablets during the pandemic, and how much is it just simply that so much of the world is flat on its back, they're not thinking about new devices?
And you see this gyrating within all of economics and, of course, the Pacific Rim we've really ignored today, and real turmoil there, including out of China as well. David Blanchflower to join us in the next hour. Dr. El Arian will join Bloomberg in the 9 o'clock hour with John Farrow. And right now joining is Alan Ruskin. This is an honor, owning the court at Royal Bank of Scotland for decades and chief international strategist for David Folkers Landau at Deutsche Bank. Alan, what I love about you is you can write a research note and 6 hours later you were wrong. You said in your research note yesterday afternoon that you thought, well, let the FX panic pass and then act. They didn't read your note. Where would we be now if the Bank of England hadn't acted this morning?
Well, I think we'd probably be in a better place, Tom. I'm pretty critical with the about the actions that we've just seen here. Most obviously, this is negative for sterling to the extent that the Bank of England is effectively adding more liquidity into the system. They are lowering nominal rates. If anything, they are lifting up price expectations, which means real rates are getting a double whammy, as it were. And the pound is under additional pressure, which then puts them under additional pressure. And, maybe they would like to see a situation where, you could see yields coming down in general. But if anything, this places more pressure on them at the front end of the curve.
November 3rd, next scheduled meeting. Alan, how big is that hike going to be?
Well, when I last looked, and that was before this latest actions, 150 basis points was effectively priced in. So the market is really pushing them into a corner to do something huge. And without them acting in that way, effectively, the pound's going to go down further. So, it remains to be seen how much will be needed on the day itself. There's obviously a lot of water that's going to flow under this bridge before then. But I would suggest that, at least 100 basis points is going to be needed at that point.
Alan, can they do anything about what's happening with pound sterling? The forces worldwide right now are incredibly powerful. The Fed hiking cycle, the dollar dominance off the back of it. Can they actually do anything to fight this?
I mean, it's a great point, John. I mean, it's a question of how much should they fight this. One of the big problems the UK has is that its balance of payments is in a seriously negative condition as far as the pound's concerned. The current account is the deficit is one of the largest out there. The narrow basic balance, when I last looked in terms of the last 12 months, was amongst the worst, really, of 45 countries that I track. So the financing needs are huge. And I think the issue is just, what is the appropriate policy mix to stem the tide, as it were. And I think the Bank of England's been backed to some extent into a corner by unorthodox fiscal policies as well.
But Alan, I guess another way of asking the same question is, how much is this a dollar story and not really a pound story, not really a euro story, not really a yen story? Or I guess
I think, obviously one should focus on euro sterling probably as the metric that tells you just how much of this is a sterling story. And by that account, you say, well, this shouldn't really count as any sort of crisis per se. If you look at sterling on a trade-weighted basis, on a real effective basis, it's not all that weak. So, don't respond in a sense. So, I have a little bit of sympathy for the idea that the dollar and is really the dominant story behind a lot of what's going on here.
When does the strong dollar in and of itself, Alan, create havoc for the rest of the world economy that rebounds back to the U.S.? At what point do we see, I don't want to say a global recession, but something that looks like that because of the strong dollar?
Yeah, I mean, I think, so far the disruptions have been quite limited, but both in terms of what we're seeing globally and the sort of feedback loops back to, U.S. Risk appetite metrics. So, I think some people would say markets are a little bit broken because the Japanese are having to intervene. I think you could say there's a yen story there and there's a BOJ divergence story that's dominant. The UK balance of payment story is unique. So far, I think we shouldn't, cry wolf too loudly. I don't think that's warranted.
Alan, who's next to blink? The ECB's Holzman is talking up another 75 basis point hike. He spoke to our colleague and good friend of this program, Maria Tadeo, earlier this morning.
She's a friend of ours?
It's a good friend of ours, Tom.
I didn't know that.
I'm not sure whether she's a good friend of yours.
Yeah.
Good friend of ours. Alan, who's next to blink?
Well, look, I think everyone is seen as tightening substantially in terms of the G10 world for this year at least. I think the blinking is probably going to start in 2023 when the US Fed cycle, essentially comes to an end. At that point in time, you presume the global economy will be in worse shape. In general, growth nationally for most economies will be, that much more in a much more serious downturn. And that point, I think, is going to be this real challenge where growth is very weak and inflation is still at much higher levels than targets suggest is warranted or desired. And at that point, I think policy is going to get into, a much more tangled and much more confused sort of state.
Alan Ruskin at Deutsche Bank.
Alan, thank you.
Alan, you're just one of the best, and it's great to catch up with you, sir, as always. TK, you say it so many times, so often. What is it, OBE?
OBE, overcome by events. Margaret Thatcher's favorite phrase. This goes back at least to World War I. I'd have to go back and look it up, John. It's very, very British, that concept. I associate it in America with Pershing, but there are going to be massive OBE events here. And, John, I'm going to bring it right back to what we heard at Jackson Hole from selected presidents. Folks, there's a beautiful veranda, if you will, outside the bar that John and I just stumbled upon. I don't know why we were there. And John was like over-listening 3 Fed presidents, 3 different poor souls. And, there's...
Mike McKee blew my cover.
Yeah, the bar conversation, John, was no different than the serious, visible conversation today. They're making it up as they go after this massive pandemic event in stimulus.
We actually shared a flight, Lisa, with the Austrian Central Bank governor. It was sat alongside Tom and I, and Tom was just shouting, what are you going to do? You're going to hike 75? 75? And he's like, looking at us like, who are these guys?
Great plane flight.
Who are these guys?
It's like, give me another one, please. Make it a double.
I'm not sure what the flight attendant was thinking was going on.
Overcome by events, that I think has a lot of credence. I just want to say this, though, John.
Sure.
So far, we've had some pretty extreme events, and that has not been considered disorderly. And we heard Katrina Dudley just there saying we haven't necessarily seen a buyer's strike. At what point does it become that kind of level? Because right now we're still not seeing it, even with all of the volatility in rates markets.
The pain that Chairman Powell talked about, Tom, the pain. It's not domestic, it's international.
Real yield, Qantas, bring it up if you can find it. The U.S. 10-year real yield intraday, we're almost out, John, to new U.S. benchmark inflation-adjusted yield highs. That is stunning.
NASDAQ futures, Tom.
Wow.
Off the back of that, we're down 1.1% on the NASDAQ. On the S&P, we're down 0.6%. It's 6 days of losses on the S&P coming into today, the longest losing streak since February 2020. Just over the last 6 days, we're down 6.5%, and we're taking out a little bit more weight from the S&P 500 this morning. Good morning to you. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Hurricane Ian is picking up strength as it roars towards southwestern Florida. Earlier today, it was upgraded to a Category 4 storm on a 5-step scale. And now its winds have increased to 155 miles an hour. That's just below a Category 5. Ian is expected to bring heavy rains and a potentially deadly storm surge. When it comes ashore late today, more than 2 million Floridians have been urged to evacuate. In the UK, inflation in shops set a record this month. The British Retail Consortium said shop price inflation accelerated to 5.7% in September. The group says that retailers are battling the weak pound, rising energy bills and commodity prices, and a tight labor market. Senior House Democrats have released their bill to restrict stock trading and ownership by members of Congress. The president and vice president, Supreme Court justices, and other high-ranking government officials would also be covered by the measure. The legislation would require them to divest current holdings or put them in a blind trust. Eisai and Biogen say their drug significantly slowed Alzheimer's disease. That makes it the first medicine to blunt progression of the most common dementia in a definitive large-scale trial. The companies will apply for full U.S. approval by the end of March. And Bloomberg's learned that Apple is backing off plans to increase production of its new iPhones this year. The company had expected a surge in demand, but that hasn't happened. Apple will aim to produce 90 million handsets in the second half of the year, roughly the same level as last year. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
When you think of cutting-edge technology at sea, you might be thinking of stuff like this. But there's an incoming revolution on the high seas that isn't quite as sexy, but could be significantly more impactful.
Container shipping is the key component of global trade. About 80 or 90% of all the world's goods are transported at sea at some point.
But there's a significant unseen cost to the modern era of global commerce.
About 3% of all the world's CO2 emissions come from shipping.
3% may not sound like a lot, but that's roughly comparable to the entire CO2 output of Germany. Since reducing trade isn't a likely option, what about a technological improvement to help reduce the emissions from these well-stocked maritime behemoths?
Lots happening on Wall Street.
I think Jay Powell said things that were indefensible.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
We think that's the next secular shift.
From businesses most influential and instrumental.
It's knocking it out of the ballpark.
It's a challenging dynamic.
This is a level of uncertainty that we haven't had to deal with.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio.
CEO Mark Rowan. In January, Apollo closed its $11 billion all-stock merger with Athene Holding. It had already owned 35% of the insurer. Here's what Apollo gets out of the deal. Assets under management. Apollo expects them to double to about $1 trillion by 2026. Much of that projected growth will come from the merger, and those assets are especially attractive to Apollo. Insurance companies typically go after much more modest returns than buyout investors. That will give Apollo more options for investing the cash. Athene is a steady provider of fee income. It has grown into one of the nation's biggest holders of fixed annuities, those retirement savings products favored by risk-averse customers. The merger will also allow Apollo to simplify its governance. It gave up its dual-class share structure and adopted a one-share, one-vote plan. The hope is that will eventually lead to Apollo's inclusion in the S&P 500.
Watching the pound today is going to be just crucial. Essentially what the pound is going to do in the next week could potentially determine the future of this government. The long end of the UK bond market has been essentially trading like there was a pending default in the UK, right? And that is causing just immense losses.
Jens Lodvig there, the CEO and founder of Exante Data, maybe the Chancellor, not looking at the polls, but just the chart of pound sterling on the Bloomberg terminal this morning. Let's whip through the price action for you. We're down 0.6% on the S&P. On the Nasdaq 100, we're down 1 full percentage point. Yields basically unchanged on a session, now 394.54. Dollar still stronger, euro dollar 95.60. The main event, though, it's right here. In the UK, the Bank of England coming out and announcing a gilt purchase operation, basically buying the long end of the yield curve in the UK bond market. Yields lower by 60 basis points, down about 59 basis points, call it 60, on a 30-year to 439. Sterling, those weaker. It's negative 1.5% to 105.71 on cable. A lot of people writing in on the Bloomberg, also making some comments on Twitter as well. This is Dario Perkins of TS Lombard in the UK, who says it's not QE, it's just a short-term operation to address an immediate risk to UK financial stability. Reassured yet, Tom?
Yeah.
You're reassured?
Yeah, Ben Emmons, I thought, had a great single sentence. This is a bond intervention, not an FX intervention, and I think that needs to be said as well. Qantas, bring up that chart if you can on the real yield. John, you got to comment on this, and I'm sorry, the real yield in the United States adjusts to what we see in the United Kingdom, really popping right back, rounded up 1.61%.
And the Nasdaq adjusts too, Tom. It's down by 1 full percentage point. So you've got all these big tech players, basically everyone in the stock market competing with that. You've seen this massive move to the front end of the yield curve. Lisa and I were talking about this in the commercial break. It's interesting the last couple of days that the front end is bid and actually the damage, the carnage in the bond market is further out along the curve. That's the consensus view. Just hide in the front end, hide in dollar cash. That means that Apple has got to put up some big numbers, the likes of Apple and other tech firms too. And Apple, Tom, based on our reporting, they're seeing demand faltering. So you've got a double hit, a double whammy here. You've got the price story in the bond market affecting the valuation story in stocks, and on top of that, you've got an earnings story as an overlay.
Qantas, we got Javier Blas coming up, but this headline is so crucial. We got to do it right now, folks. The Bank of England acted amid concerns a Wednesday cash call would trigger gilt crash. John, I've never seen that headline in my life.
Tom, I think Guy went through it really well, and he'll do it again in the next hour. This came from the financial stability side of the bank.
Exactly.
Not the monetary policy side. On the monetary policy side, they've still got work to do. Based on market pricing, a lot of work. And the next scheduled meeting, Tom, still more than a month away. We've got to get through the whole of October for the next scheduled meeting from this Bank of England.
Let's go to Javier Blas right now. We're going to talk about things prosaic like Ukraine, Germany, and the rest. But Javier, I've got to talk about some great calculations by the ITV network of the United Kingdom on your world. And when you get currency devaluation or depreciation, a liter of petrol becomes more expensive. Explain, Javier, the global price of hydrocarbons and how it affects the little guy filling up his MG in the United Kingdom.
Well, Tom, almost every commodity in the world is priced in US dollars. Even tea is priced in US dollars. That's the quintessential British drink. The pound is just depreciating very fast against the dollar. Everything, natural resources that we buy, is priced in dollars. Your purchasing power in pounds is going down, so everything is getting more expensive. From crude oil, gasoline, to a bag of tea for your morning cup.
Fold into Nord Stream here in the debate over the last number of days of gas bubbles floating out of a given sea. Fold in your view, Javier, of the zeitgeist that oil will reverse and go up to higher prices again. Is that a consensus belief?
No, it's not a consensus belief. I mean, if you talk to the physical oil traders, they believe that the market is relatively healthy, that demand right now is still there. But obviously, the economy, particularly here in Europe, is slowing down quite a lot. But my main concern on both oil and gas markets is that we are, today, this morning, coming into the office in central London was the first day that I say, oh, it's a bit cold. The winter is just arriving, the fall is arriving, the winter is arriving, and we are going to see higher demand through the next 3, 4, 5 months. And to say that, you know, we are out of the energy crisis, as some people are saying, that the worst is behind us, I think is way too early. We don't know how the winter is going to be, and that's a big concern for mine.
Have we already priced in, Javier, the idea that we will not be getting or not be seeing Russian gas gas transported through Nord Stream 1 again, and certainly not throughout this winter.
I think that's beginning to, that's now more or less completely priced in after yesterday's event. Certainly the Nord Stream 1 and Nord Stream 2 are not going to come back anytime soon, even if Russia wanted to send the gas or Europe wanted to buy it. The pipelines are effectively destroyed for the foreseeable future. We are beginning to price that also we may lose supply from Russia via Ukraine, where a pipeline is still working. But I think that the biggest concern right now on the gas market in Europe is what's next. We are effectively at war with Vladimir Putin. It's an asymmetric war, it's an economic war. And what if something else happens? What if Russia attacks some of the infrastructure in the North Sea? Europe is crisscrossed by pipelines, oil and gas, by thousands of miles of overhead electric grid. We saw last year what happened with gasoline supply in the United States East Coast after the cyber attack on Colonial Pipeline. What is the potential for cyber attacks this winter? That is one thing that everyone in the European energy industry is extremely concerned right now. What if Russia launches a cyber attack against the energy infrastructure of Europe?
Javier, thank you, sir. The risk just building, mounting, going into winter for the Europeans. Javier Blas of Bloomberg Opinion. Crude right now, positive 0.25% on Brent, 86.50 on WTI, 78.85. We're positive there, 0.5%. Story of the morning, equity market down 0.6% on the S&P. On the Nasdaq, we're down 1 percentage point. A report from Bloomberg that demand for the iPhone is faltering. Apple down in the pre-market by about 3%. The big moves, though, in the bond market, through 4% briefly on a 10-year in America, then back below that level at 393.92. Just massive moves, monster moves in the UK gilt market off the back of a central bank operation from the BOE. The 30-year Tom down by 60 basis points to 4.39.
I mentioned that headline, John. It is from Philip Aldrich at Bloomberg in London. John, I know you're going to bring it up and do it better than me. The Bank of England's decision to announce unlimited and immediate purchases was prompted by fears that collateral calls as soon as Wednesday afternoon would trigger a further crash in gilts. That is a wow sentence from Bloomberg.
That is a suggestion that they sense some real stress, at least from the financial system.
And it's surprising we haven't seen more of that. I'm going to editorialize there because these moves are violent, and these are some of the main instruments used for reserves, for the safe assets, which could cause forced selling. So at what point do we see more of this? At what point do we see these sort of tortured financial stability measures at the same time of tightening monetary policy?
A little bit in the weeds, Lisa, but we've talked about this a few times now. Yield curve in America, bull steepening, which means the front end yields are dropping. So the curve steepens, but it's driven by the front end. We're down 7 basis points. That happens when bad things are happening, I would suggest.
I would suggest you're correct.
Successful company, but you might not want to run it for the next 10, 15, 20 years, or do you? And if you didn't, would you want to go into government? If the president called you to serve our country, would you go into government, or would you start another company?
I love what I do. And I feel like I have this luxury with 23andMe that it keeps evolving. You know, we started out just as a consumer company. We're thick in research. We got into drug discovery in 2015, and now we're getting to the delivery of care. So I've been really lucky with 23andMe that it's been endlessly interesting. And I'm surrounded by incredible incredibly talented, brilliant individuals where I learn from them. And what I always advise people to do is like you should take jobs where you're learning. And if you stop learning in a job, then you should quit. And like frankly, when people leave 23andMe, like I say, if you're not learning anymore, you should move on. So I'm 100% committed to 23andMe. That said, my other passion is other direct-to-consumer. Like, I want to build out a true consumer-empowered healthcare world, like one that is outside of the existing system. And there's no greater force than government.
Markets are preparing to close, but the day is not over yet.
Stock that is now up about 45%.
A lot of volatility right now.
You need the power of the Bloomberg terminal to get you market-moving data before anyone else.
These numbers are much higher than expected.
Upgraded today to overweight.
You need top analysts to bring you exclusive global insight into cross-asset markets.
The muni bond market.
China is a really big focus.
Bitcoin ain't playing along today.
It's going to be short term.
Bloomberg Markets, The Close, weekdays on Bloomberg.
When you've had your fill of IPOs, ETFs, and CPI,
tune into the lineup for some NFL, NBA, and MLB. Did you retire too early? I mean, look at some of these payouts.
I absolutely retired too early.
For the inside scoop on sports betting, catch the lineup right here on Bloomberg.
Enjoy the excitement of a night of music at Boston Symphony Hall with BSO Now. Watch brand new Boston Symphony Orchestra performances, behind-the-scenes storytelling, and memorable archival concerts, all from the comfort of home. Use our free 24-hour trial and see why the Boston Globe calls it musically rewarding, and the Berkshire Edge says the orchestra has never played better. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
Everybody wants to get inflation down. The labor market's still very strong, and so the pain hasn't really materialized yet.
The Bank of England has consistently failed to meet what the market has priced in for where rates should be in the UK.
Right now, credibility is the key.
You've got to take the Fed at its face value.
The Fed is going to continue raising rates.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene. It is 30 years ago and 11 days away from a crisis for the United Kingdom. It is a crisis again this morning, and George Soros is not involved. John, it's simple. Can the events of this morning break the Bank of England?
The Bank of England responding by buying bonds at the long end for a limited time, Tom, and driving yields lower, much lower. And according to a person familiar with the matter, with the policymaker decision this morning, Phil Aldrich of Bloomberg, Tom, reporting that they did this today out of concern that we could see a gilt crash off the back of cash calls. They were responding, Tom, to financial stability risk. That's a big distinction that Guy Johnson made a little bit earlier as well.
Then goes back to the Green Book of the IMF, where they look at financial stability, and the shocking essay we saw last night from the IMF. For all of you worldwide on radio and television, I can't convey the advantage of having John Farrow with us with his bulletproof knowledge of what's going on in the gilt market and what it means for America as well. John, let's try to summarize here before Blanchflower, before Malik, before El Arian later on this morning. Your thought, John, and your nation falling apart.
Look, policy is in conflict. I'm not sure if the country's falling apart, but the market has been in the last week. And policy is in conflict, and we know that, and that's problematic. But that's a smaller piece of a much, much bigger puzzle. And the Fed is a huge feature in that. Global bond yields have been surging. The dollar has been absolutely dominant. And as Deutsche Bank said, I think it was Deutsche Bank earlier this week, if the trigger was that mini budget last week for what's played out in the UK, the cause, Tom, the cause is elsewhere.
Well, I look where the cause is elsewhere, and the answer is it's global. Lisa, you've been following this, and I'm sorry, Lisa, the thermometer of this maybe is away from full faith and credit and is seen in the spread market. Has spreads moved on this tumult of the last 3 days?
They have. And you're starting to hear about BWICs, or bids wanted in competition lists, being sent out, big ones by possibly foreign investors, is according to a number of different sources, basically saying this pain that you're seeing in the rest of the world, in the UK, in Japan, is leading investors over there to sell U.S. assets, in particularly top-rated credit. How much does this become a rebound effect into the U.S., even if the Fed is looking at a very stable, or a much more stable, I should say, and a much stronger consumer? This is what a lot of people are wondering. When is that break point going to happen?
John, I want to slide into the data check with just two quick observations. Euro Swissy, the mother of all safe trades, goes to new strong Swissy this morning as a generalization. And also sterling, what, John, a 107 for a cup of brown water, as Ted Lasso would say?
Yeah, not for long. 105.94.
105.94. I mean, it's fragile, to say the least.
I would say the move that stands out for me today is actually the front end of the Treasury curve, with the 2-year down by 9 or 10 basis points. And I'll keep going back to this. The curve today is bull steepening. The consensus view right now is dollar cash, tied in the front end because bad things are happening. And that's taking place against the Federal Reserve, which is suggesting they're going to keep on hiking. So out of everything, Tom, bigger picture, away from the drama in the UK for a moment, the front end of the US curve that gets my attention.
Well, it does, and you see it with the real yield as well. Look for that on Friday as well worldwide, and the real yield is gyrating all morning, John. John, I think we just, we got so much to talk about, and with Blanchflower joining us later. Right now, with a real world view, I should say, Sarah Malik joins us, Chief Investment Officer at Nuveen. Sarah, do you ignore this within conventional institutional money? How do you sift in the tumult of the last 3 days?
I think as long as the dollar and yields continue to move upward, investors need to brace themselves for more pain. Now, there's a few things on the horizon that might at least give us some stability here, and that's earnings and some cracks that we're seeing in inflation, and also watching technicals. Unfortunately, we seem to be breaking through the June lows, which means we probably hit 3,500 on the S&P 500. But earnings, we're seeing consensus start to decline a bit, and earnings generally don't crack until PMIs go into contractionary territory. So I think actually Q3 earnings could be okay, give investors a bit of a short-term sigh of relief. And then also inflation still remains very hot, but we are seeing some moderation in rents, which is a big piece of core inflation. So you might at least start to see a plateau in inflation, which I think, again, at this point, that could be a positive for investors. Short-term bounce, but again, some stabilization for the markets would be a good thing.
Sarah, the pushback we get against the earnings bears is that we live in a nominal world, and nominal growth has been phenomenal because inflation is so high, and how can you push back against earnings in that environment? Sarah, you can if you get focused on margins, on costs. What do margins look like going into year end?
I agree, margins are a real issue for earnings because they're basically at peak levels, and with the cost inputs coming in, only those companies with pricing power will be able to maintain or expand margins. Also, the dollar's a headwind for earnings, and some of these signs of demand destruction are eventually going to hit earnings. The question is, what's the timing of that? Likely not the third quarter, but it is to come. Similar to the employment market, when does that crack? Probably sometime early 2023, and that's when you hit your recession. So I don't think we can just hang on to the positive earnings of the third quarter, but given where the market is right now in terms of valuations, that it might at least just help us stabilize because they should come in all right for this quarter.
Sarah, as an investor, when do market directions, market momentum, when does that overcome some of these fundamental considerations like margins and earnings, and how quickly this bleeds out into the economy?
Well, I think when you get into these periods of extreme stress like we're seeing now, it's somewhat of an unwind given what's going on outside of the U.S. and also the continued pain from higher yields, which makes equities less attractive. We do turn somewhat to technicals to see, can the market hold some of its lows and moving averages? The issue, of course, is that it's not really holding those. And I think until we can technically get to a more stable level, markets are going to just keep declining due to these higher yields, higher inflation numbers, and fears over when is the next shoe to drop? Is it going to be in the UK? Is it going to be in Russia and Ukraine? And some of these areas that just keep piling on to the negative narrative happening.
Sounds like people are hiding under their beds with a whole lot of cash, just sort of sitting there waiting for it to pass. Are you? Is that what's going on? Or is there something else that you're kind of figuring out how to play in here?
I mean, I get the reason, cash and yields are actually quite attractive, and that is a headwind for equities. So equities are challenging, but we're finding areas that are attractive, such as dividend growers. They actually look cheap versus some of the typical bond proxies that look expensive to us right now. They can provide you income and protect you against some volatility. We like fixed income here. High yield actually is offering very strong returns in the high single digits. It's much higher quality than it was in the past. And then look for asset classes that actually can benefit from higher inflation, such as farmland, private real estate, where CPI escalators are written into some of their contracts.
Let's go to core competencies, Sarah. Tell me what municipal bonds are doing at Nuveen. You guys own that franchise. Are tax-free bonds a place to be?
I think that's another area with strong fundamentals that's been hit with outflows and also a lot of the negative sentiment that's hitting many asset classes. But it's similar to high yield on taxable fixed. Strong returns for municipal bonds. Municipalities are have very healthy coffers right now. So municipal bonds is another area that we think is quite attractive. It's where you can get more bang for your buck. So a little bit less risk, lower correlation to other asset classes, but good returns to help you wade through a lot of this pain.
Sarah, how many times have you been told that Apple iPhone demand is faltering? That's the reporting from us this morning.
It's interesting because Apple is a post-COVID story. We've been waiting a long time for that normalization after the extremely strong demand we saw for all of their products during COVID, and that unwind hasn't happened. So it is interesting to see it finally start to catch up to Apple. Not surprising. I think all of these issues for these companies that had very strong, unusual demand during COVID are eventually going to have to normalize. That process could be painful even for Apple.
Sarah Malik, thank you. Wonderful to catch up of Nuveen with your equity market, negative a third of 1% on the S&P, down 0.75% on the Nasdaq 100. The main event today, central bank intervention, the Bank of England back in the market. It is no longer QE. It is no longer QT. It is now, for many of us, quantitative confusion, with Governor Bailey and this Bank of England, Tom, at the epicenter.
Well, yeah, the Governor Bailey's at the epicenter, but again, as we said all morning, it's not just about the Bank of England. To me, at the epicenter is the Truss government. John, I never pretended to understand British politics, but this is a most unusual politics. Like, are they going to do the thing in the House of Commons where they stand up and scream at each other?
They will.
Does that happen today?
There will be a budget, I believe, in November. Do you mean question time with the Prime Minister?
Yeah, question time.
Yeah, Prime Minister's questions.
Yeah.
I'll get you a date on that, Tom.
No, it was folks at the hotel we were at in London as we held court there.
You and I were doing.
Funeral, we were doing Prime Minister's questions, you know.
Lisa was the Prime Minister.
I want eggs.
Lisa made a speech and then Tom walked out.
Sounds pretty much.
Tom actually did walk out.
Like every day. I do think this is a really compelling moment. And I loved this whole idea of quantitative confusion because what you're dealing with are nodes of contagion, nodes of dysfunction. And while you have the U.S. and you have Janet Yellen, who may or may not be part of this administration during the next reiteration, there is a question of whether the U.S. stability can persist in the face of dysfunction, nodes of dysfunction around the rest of the world.
I saw that Axios report on Secretary Yellen, perhaps no longer remaining Secretary Yellen.
And Mr. Deese as well.
Yeah, exactly.
Yeah, and Mr. Deese as well. You wonder who replaces them, Lisa.
And you wonder what the tone is if they're coming out saying everything's fine and really supporting the Fed, really supporting the rate hikes, allowing the economy to wilt in order to combat inflation. Again, this goes to the credibility of central banks and this wondering of when they blink, because is there a withering of conviction here of letting them just keep going?
It's Conviction Wednesday.
Conviction Wednesday, or lack thereof, Tom. I think it's lack thereof. Confusion Wednesday's probably about right, Lisa, that's for sure. Coming up shortly, Bradley Rogoff, the head of fixed income research at Barclays. Looking forward to that conversation, and what a time for it. Yields absolutely plunging in the UK as the Bank of England gets involved and starts buying the long end for a limited period of time, and sterling's still a whole lot weaker. Cable all over the place this morning on the British pound. We're at 105.83 from New York. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Hurricane Ian is rapidly gaining strength as it approaches the western coast of Florida. Its winds have been measured at 155 miles an hour. Now that's just a couple miles below reaching Category 5 strength, the most powerful rating for a storm. Ian is on track to come ashore later today. Yesterday, Tampa was facing a direct hit. Now the hurricane is expected to make landfall near Fort Myers, a 2-hour drive south. The Bank of England is taking steps to restore order to the market. It says it will buy long-dated UK government bonds in whatever quantities are needed. That's the central bank's biggest response yet to the fallout from Prime Minister Liz Truss's historic tax-cutting plan. In Russia, the Kremlin has declared victory in a series of UN-condemned referendums in Ukraine. Voters in 4 regions occupied by Russian troops have voted to become a part of Russia. Moscow ordered the votes after its forces suffered their worst defeats to Ukraine's military since the start of the war. And Bloomberg's learned that Apple is backing off plans to increase production of its new iPhones this year. The company had expected a surge in demand, but that hasn't happened. Apple will aim to produce 90 million handsets in the second half of the year, roughly the same level as last year. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
When the price of anything goes up, the consequences reach far beyond what you'd expect. But perhaps most of all, when it comes to food. In 2010, surging food prices helped spark the Arab Spring. Lives were lost, regimes fell, and the consequences are still with us. Once again, food prices are rising, and fast. Energy costs, broken supply chains, and surging demand were just some of the factors that have driven food prices to their first record high since the Arab Spring. And that's all before a war between 2 of the world's biggest food producers. Ukraine is called the breadbasket of Europe, and taken with Russia, the 2 account for about a quarter of global wheat trade. They produce more than half of the world's sunflower seeds and oil, nearly 20% of the barley. Now throw in rising energy prices, and processing, transporting, even refrigerating food gets more expensive. Plus, fertilizer production is extremely energy intensive. Less fertilizer means lower crop yield, and prices rise even more. The pandemic revealed how complicated and fragile global trade systems are. Global agriculture, perhaps even more so. Unlike metals, for example, food goes bad. And crops take months to grow and are vulnerable to unpredictabilities like the weather. Rising food prices will be felt everywhere, but the poorest countries in the world will be hit the hardest. And as all these factors compound, the real fear is that record high will lead to record high, and ultimately to a global food crisis with vast consequence.
The difference between missed opportunity and actionable intelligence. For in-house attorneys who strive to provide superior counsel and strategic advice, Bloomberg Law offers an unmatched platform of analytics tools and business intelligence. All to help improve productivity, mitigate risk, and inform decision-making. For the comprehensive platform that helps you work smarter and faster, the difference is Bloomberg Law.
From New York City.
In London, in Sydney.
In San Francisco.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching. You do not want to miss this
How
story.
are you thinking about those dynamics?
Power, policy, politics. From the White House to the Hill, Bloomberg covers the leaders in legislation.
That was really a tectonic shift for this White House.
The theory of this bill, as I understand it, is there'll be a multiplier effect. How did Democrats mobilize specifically younger voters?
Bringing you the political news you need to know.
The president has made it very clear that this is a significant focus.
For the intersection of Wall Street and Washington, nobody covers politics like Bloomberg.
confident that the UK will come through this. I cannot tell you actually what the today's rates move are, and volatility, as I said, stays. But I can also see that over time the pound is coming back.
Christian Savin making a big call, the Deutsche Bank CEO, live from New York this morning. Good morning. He also talked about a much deeper recession in the next 12 months in Germany and Europe. Yeah. That's the Deutsche Bank chief, Tom, talking up a deeper recession in Europe at a time the ECB is not even forecasting one as the base case.
But to the cash collateral headline from Philip Aldrich a bit ago, John, you really wonder how this redounds over to banks. I forget value at risk and all this other Talebian mumbo jumbo about tail risk and all that. This is absolutely unique, and you wonder what it does to trading desks.
They are massive moves, Tom.
Yeah.
And the move today is just as large. We're down 62 basis points on a 30-year in the UK as the Bank of England announces a gilt market operation. And Tom, still, and we can talk about this, sterling against the US dollar, just about at 106, negative 1.2% on the day.
I think we're waiting for the next headlines, and particularly from the trust government as well. We welcome all of you on radio and television worldwide. Truly an historic day, literally a special edition of Bloomberg as we go guest to guest with adult perspective. We do that now with somebody in the trenches. Bradley Rogoff is he's a Marine at Barclays, I guess is how I'd put it. He's head of FIC research at Barclays. And we're going to talk right now, not about the nuances of what Barclays doing this moment as a British bank. And, you know, if anybody's jumping in the Thames over at Canary Wharf and all that. But we've never seen this before. How do you manage your traders and the research you provide them? How do you manage +4 to -5 standard deviation moves? We've never seen this. How do you do that?
Yeah, it's certainly not easy. And you think about, I've got my start and I spent a lot of my time on the credit markets, and we're talking about inflation, and then the riskiest parts of the credit markets, think about things like high yield. Market literally never existed in a time where we've had inflation like this. And what I would say, though, is what's been pretty amazing is for all of these crazy standard deviation moves that we've had in rate markets, we've had them in currency markets, you've actually seen credit risk remain fairly benign. We have not had those kind of moves there, right? And so for us, it's really figuring out, okay, how correlated are these markets right now? And then to your point, you need to have some tail risk, some hedges on for that across different markets.
So, Brad, what explains exactly that point, this sense of resilience in credit markets at a time when the rest of the world is falling apart?
It's surprising to us. Look, our forecasts are that we think credit spreads should be a decent amount wider. Now, clearly they've widened the last few days, but we were wider, June, for example, versus where we are right now. I think the answer to that is the data. If you look LTM, if you look more recently in the recent months, it's still held up okay. I mean, the consumer, especially in the U.S., has held up, right? And so U.S. credit markets especially are where we've seen actually the best performance from a spread perspective globally.
Some people are saying that there will be downgrades, yourself among them, saying perhaps people are not accounting for how quickly this economic cycle is moving. We're seeing that with expectations for earnings to depreciate and earnings expectations on the equity front. How much are people mispricing the downgrades in credit?
Yeah, look, we don't expect there to necessarily be massive downgrades the way we saw when COVID hit, right? That is a very extreme example, and just we're talking about unprecedented times. Well, that was certainly unprecedented times as well. But you have to think we've had these companies delever. They're going to get a lot of margin pressure in here as a result of inflation. You got to see that turnaround where we've had numerous upgrades, and really this upgrade to downgrade ratio way higher than we would have expected recently.
As you speak, I'm reading the formal document from the Bank of England. Totally unfair to you, Bradley. I want to make that clear.
That's right, live TV.
But live TV, let's go live right now. If they're going to come in at 3 p.m. their time this afternoon and do this original mechanism, are they doing it surgically in the secondary market to people beleaguered, or are they doing it to everyone?
Yeah, look, as you say, it's live. I don't know exactly the mechanism that they're going to use at this point, but I think it has to be just for the market as a whole, right? You look at what the market has done over there and the reaction that we've had, and you mentioned these standard deviation moves and just how much the UK has taken the pain, whether it's through the rates market or through the FX market, relative to any other market, and then you look at any other unprecedented time we've had really since the financial crisis, and what success central banks have had stepping in. And I think that's the playbook that they have to lean on right now.
Brad, what is the international influence on U.S. credit markets in terms of their holdings of U.S. credit that, according to a number of anecdotes this morning, they're starting to sell in mass to raise capital?
Yeah, that's really connected to those two questions, actually, because a lot of the questions I get on the FX move when we think about credit markets come down to, okay, there's a corporate, they sell a lot of their goods overseas, right? And so that's going to have some impact ultimately on their bottom line when you see an FX move like this. Absolutely true, right? But most of those are high-quality corporates, and yeah, you could argue spreads should be a little bit wider, but certainly not a disaster. I actually think the bigger factor right now is when you think about these currency moves and just how much foreign buying there has been of dollar debt, right? And we can talk about treasuries too, but really if we focus on corporates for a second, that was the place that you could get yield. And when you were looking at, you guys have shown all those charts of how many billions and trillions of dollars of negative yielding assets there were, only go back to the beginning of this year. That forced everyone into U.S. corporates. And one thing we're seeing with this currency move is there are a lot of foreign holders of U.S. corporate bonds that are selling, but they're not necessarily even making the choice to sell. They have to because of that currency move if they're not perfectly hedged. So I think it continues to have an impact. I think that the fund flow numbers that we look at, we report, right? We could show them every week, every day. I don't think they tell the full story because those are looking at U.S. mutual funds for the most part. And a lot of the selling and outflows are actually going to be foreign-based.
Bradley, this is really smart stuff. Let's continue the conversation soon. Bradley Rogoff there of Barclays. Bramo, super smart stuff.
Especially at a time when this is a correlated world with a lot of international flows that are not tracked in traditional ways, and things are moving so quickly. How do you parse out interest rate risk? How do you price out FX risk from credit risk and from international risk? And that's what you're seeing right now.
Front end in the US Treasury curve. It's down 12 basis points today. Negative 12 basis points, Lisa, to 4.16%.
This has been the one consensus from all the people we've had on the show. By the front end, this is a place to hide out at a time when there's so much uncertainty. The interesting thing is that the long end is not keeping pace, as you pointed out, that bear steepening that you're seeing, people looking at the potential for maybe inflation to become unmoored or a global situation with more forced selling.
John, 8 minutes ago, and it did move the market. This market notice sets out details of the bank's temporary purchases, et cetera, and it is a detailed note. We don't need to go into the note right now. Frankly, I don't understand half of it, but
well, thanks for bringing it up.
I'm glad I brought it up, but it moved the market. It firmed up sterling a little bit, and it pulled back the U.S. 10-year inflation-adjusted yield. So they're going step by step. Where's the government, John?
So you asked about PMQs, Tom. Had a lot of people write in and explain why they weren't on this week because of the party conferences. I'm told October 11th is when PMQs, Tom, will return.
Oh, okay.
Is that helpful?
Well, I don't know. I'm trying to get there September 30th for the Derby. And,
So Parliament will return on October 11th, and then the following day you get PMQs. So that'll be October 12th. There we go.
Isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
somebody says, I want to be, and a person has an impact on society, what would you recommend that somebody do to work their way up?
Well, I think the first thing you've got to believe in something that you really care about.
Nutrigenomics and precision nutrition is one of those rare scientific fields that overlaps with the Instagram-friendly wellness industry.
There is a lot of interest in this idea of personalized nutrition and especially how accessible it is to the public. You can go on Google and type personalized nutrition or diet and genes, and you will find dozens of different companies that offer this nutrition precision tests.
One of those companies is Routine. Routine claims that their personalized tests stemming from sciences like nutrigenomics make their supplements different. But even with the claims from Routine, as well as dozens of other personalized nutrition companies, the science still has a long way to go.
From the world of politics to the world of business. Balance of Power with David Weston. News, analysis, insight from and about politics power players. Weekdays. This is Bloomberg. Lots happening on Wall Street.
I think Jay Powell said things that were indefensible.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
We think that's the next secular shift.
From businesses most influential and instrumental.
It's knocking it out of the ballpark.
It's a challenging dynamic.
This is a level of uncertainty that we haven't had to deal with.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio.
Feels like it's Friday. I don't know, November 22nd or something.
Years felt like Friday.
I think we're not even at the end of September. We're not. It's Wednesday. My producers are telling me. Futures are down 1/10 of 1% on the S&P.
You're going to make it Friday anyway.
On the NASDAQ, we're down 1/2 of 1%. I mean, what a week. One of those weeks when, what did they used to say? A week where decades happen or something like that? You know, in markets, just unreal. Yields down by 5 basis points on a 10-year, 389 on a 10-year. Dollar stronger, euro dollar 95.78. Futures negative 0.2 on the S&P, on the NASDAQ, down 0.6. Just a wild morning in UK markets. Take a look at the 30-year gilt. Yields getting absolutely slammed lower, down by 82 basis points. Just pause on that. Down 82 basis points on a UK 30-year at 4.16. Wild as the Bank of England announces it's getting involved in this market. And if 80 sounds like a big move to you, it's because it is. If we closed here, it would be the biggest one-day move lower in history. But I think the fact that it takes you back basically to the lows of Monday tells you something about where we've been. Tom, we've just seen a massive surge in gilt yields. And the Bank of England, according to our reporting, was very concerned about risk in the gilt market, disorderly moves, dysfunctional moves that they had to address from a financial stability perspective and not from a monetary policy perspective to attack inflation.
It's a huge distinction in that, you talk about what they need to do for the people of the United Kingdom. We mentioned home mortgages and such, but if it's financial conditions, that's something all of these institutions, John, really take seriously.
And they're taking it very seriously, and that's why they've responded, Tom. But we've still got to wait for the budget from the UK in the next month. We've got to wait for a Bank of England rate decision. I joke that it feels like November 22nd. I tell you, it's going to be another month and change before we have a scheduled Bank of England rate decision. And Tom, based on what we've seen in the last week, I think people are right to ask whether they can wait. Can they wait that long?
We talked to 4 or 5 people. Maybe we expand out to 12 people at the Fed at Jackson Hole. And the reality is the Young Turks are in Washington and spread across the country at the Fed. The Young Turks are brilliant PhD chaps. They do very, very well. You don't ever hear about them. And one of them that has served the Fed is Jonathan Pingle, who's chief U.S. economist at UBS, working with the monetary analysis and quantitative section at the Fed. John, what's it like away from the lights, away from the press conference. What is it like in the trenches for the PhDs at the Fed?
Well, thanks, Tom. Thanks for having me on. The PhDs are going to be hard at work. I mean, I had an exchange with a former colleague of mine, and it's sort of a shame that some of the most interesting points in our career were a financial crisis or a pandemic. But these are the times when, sort of the institution kind of goes into overdrive.
Right.
And I think they're doing a lot of work trying to understand what's going on in a highly volatile environment.
Is there a debate about a Fed that is overreaching on a given visible theory? How does that work with 45 PhDs going back and forth? Is it a heated debate right now for Jerome Powell, or is everybody like, yes, Chairman, we are behind you?
Well, I suspect it is a heated debate. I mean, there's a lot of uncertainty, and you certainly hear that in Chair Powell's comments. I mean, was very frank in his comments after the meeting last Wednesday. And you can go back to, his 2018 Jackson Hole speech about the stars, where he's talking about R star, U star, pi star, and just the uncertainty of knowing where any of these sort of targets for the economy and guideposts for policy sit in real time. So I'm sure there's very heated debates going on about what to do and how to do it. But they do have a very singular problem in their minds at the moment, and that one problem is inflation's too high.
Jonathan, we were talking with Bill Dudley this week about the pitfalls of not being honest about a downturn being put into some of those projections from Federal Reserve economists. That basically this gives the market room to question their conviction about really staying the course even as the economy deteriorates. Would you agree? Do you think that that is what is being transmitted right now in markets, the message to the Fed?
I think so. I kind of agree with that sentiment looking at their GDP forecast in the SEP, but I think that their tone, tenor, and the words that they're saying are that they are certainly willing to risk recession. And Chair Powell, I think, was quite frank. In fact, unusually and remarkably frank about the recession possibility in his press conference last week. And I don't think any of the speakers since then have really backed off that kind of tone. I mean, I think the hard landing risks are rising. I think that, Chair Powell basically admitted as such, saying, we don't know if there's going to be a recession or even how severe it might be, but really making the case that that risk is worth it to bring inflation down. And I think the markets are getting that message.
Right now we're hearing about the crisis in Europe escalating as the European region prepares for Nord Stream 1 not coming back online, and essentially warfare being expressed through the energy supply to the region. How concerned are you about some sort of market crisis, market dysfunction globally, but also in the U.S. that causes an acceleration of the downturn?
Oh, that's a great question. So when I think about what the Bank of England's doing today, I mean, the central banks really hate dislocation. So, when I think about disorderly markets, I do think we have, the central banks that, are kind of on the ready. When I think about the spillovers from Nord Stream, the risks to the U.S., those are very real risks. I mean, we're insulated a little bit in the sense that things like exports are not a really huge share of GDP. But you can see weighing on sentiment, risk valuations, some of the spillovers as investors are becoming increasingly concerned about, not just the U.S. economic outlook, but the global outlook. I mean, our economists in Europe are calling for a recession in Europe. And, certainly we think the recession risks in the U.S. here are high as well.
And now, folks, that point in Bloomberg Surveillance, a special edition of Bloomberg Surveillance, where we try to pretend there isn't a global financial crisis. Jonathan, I actually tried to calculate with the 30-year mortgage surging how much less house a given person could buy. I was stunned. It was 25% less house from 3.10 bank rate 30-year out to like 7% or wherever we are right now. The UBS update on the state of renting, buying, and multifamily.
Yeah, so we are not particularly optimistic about residential construction. We've had declines in housing starts for some time in our forecast. The decline in house prices that was reported in yesterday's data, I think, is kind of a warning sign. that index is basically a 3-month moving average of something that's usually kind of sticky to the downside, but we're already seeing prices start to fall. So it has to make one worry about just the general outlook for housing. And outside of some of the big cities, we've actually seen a pretty meaningful slowdown in rent growth too. Now that hasn't fed through to the CPI, but if you're looking at some of the big data sources like Apartment List or Zillow, there's been a pretty meaningful slowing. So there seems to be a quite broad slowdown in housing at the moment.
Isn't this really good for the Fed? Isn't this exactly what they wanted and actually going to bring down CPI faster than many people had expected?
So you'd hope, but it takes time for these rents for new leases to feed into the CPI. I mean, it can be as long as a 6 to 12 month lag. And Chair Powell, I think, kind of admitted as much in his press conference last Wednesday when he said, rent inflation could remain elevated for some time. But it creates attention for the Fed because they are moving rates higher at a pretty rapid clip. I mean, 300 basis points in the 6 to 7 months that they've done that. I mean, no FOMC since '84 has risen rates by 225 basis points in that period. So there is a question about whether or not they are giving the real economy time to see any slowdown in inflation that might make them sort of rethink the overall level of which they need to set policy rates. I mean, they're moving so fast, there's not a lot of time to evaluate the impact on the real economy. And given the lags for some of this inflation data, that's kind of a concern.
Everything's moving quickly. Tom asked me at the top of the hour, 40 minutes ago, what I was looking at. And I said it was the front end of the yield curve in the US. And I know there's a lot going on in the UK. But Lisa, to see the front end, the 2-year down 18 basis points now on the day, this curve is ball steepening pretty aggressively. It's driven by the front end dropping lower and dropping hard.
And how much is this because people think that the Fed is going to blink or going to pull back? And how much is this just people piling into the one consensus, which is real yield and real yield in short-term bonds?
Jonathan, just to get your thoughts on this, does that scream risk aversion to you, Jonathan?
So, I mean, we periodically have seen moves in sort of the policy mistake trade get done and undone. But I do think that, when the dust settles, the Fed's message is going to be there. We've got a bunch of Fed speakers coming out today, and I think it's going to be digested that the Fed's not going to blink. I think that one way or another, they are pretty determined to bring inflation back to 2%. The Volcker policy experience is widely viewed as a success, gives them a certain amount of political cover. And I think with that example behind them, I think they are pretty determined, and they sure sound determined, even at the risk of growth and recession.
Jonathan Pingle, thank you, sir, of UBS, the chief economist. Equities turning around as well. We're positive by 0.2% on the S&P. Lisa, we are down on the NASDAQ by about 0.2%. We were down across the board by more than 1 full percentage point when we started chatting about 2 hours, 40 minutes ago.
Yeah, and how much is this not really about what the Fed does, but about the fact that the global picture is moving away from the Fed and deteriorating fast enough that the conditions will be such that will allow them to move away from perhaps raising rates as quickly, which is why perhaps people are getting so much more conviction to go into the 2-year.
TK, we're making history here, aren't we, in the gilt market? Yeah. Down 86 basis points on a 30-year.
That's right where I wanted to go. I just did that study, John. I want to make a difference here. There's huge standard deviation moves in currency, less so in bonds. The 30-year comes right back to trend, back to the middle of August.
The 10s-30 curve in the UK, according to our colleagues, inverting for the first time since 2008. I don't know if there's an economic signal in there, Lisa. I think that is purely just ridiculous moves at the long end of the curve driven by the Bank of England intervening. Just absolutely unreal. Down 87 basis points on a 30-year, back to 4.1%, which is, I think, where we were at some point last Friday. From New York, this is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Hurricane Ian is rapidly gaining strength as it approaches the western coast of Florida. Its winds have been measured at 155 miles an hour. That's just a couple of miles below reaching Category 5 strength, the most powerful rating for a storm. Ian is on track to come ashore later today. Yesterday, Tampa was facing a direct hit, but now the hurricane is expected to make landfall near Fort Myers, a 2-hour drive south. Some scientists are calling gas leaks from the Nord Stream pipeline an unprecedented climate disaster. This 700-meter wide pool of bubbling water in the Baltic Sea is the most visible of the 3 leaks. Experts are trying to figure out how much methane gas has escaped into the atmosphere. The fear is that it could be one of the worst releases ever. Senior House Democrats have released their bill to restrict stocks trading and ownership by members of Congress. The president and vice president, Supreme Court justices, and other high-ranking government officials would also be covered by the measure. The legislation would require them to divest current holdings or put them in a blind trust. And Ford hopes its new gas-fueled pickup will help fund its electric vehicle future. The automaker unveiled its massive redesigned F-Series Super Duty truck at Louisville's Churchill Downs. Ford says the truck generates more in annual revenue than Southwest Airlines, which last year pulled in nearly $16 billion. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
What are the moonshots at Amazon that are capturing most of your time and attention?
Well, we have a unique way that we look at big new investments, and I'm not sure it's right or wrong. It just happens to be our way. And we ask ourselves when we're considering something 4 questions. We ask, if it's successful, can it be big and move the needle at Amazon? Is it being well served today? Do we have a differentiated approach? And do we have competence there? And if not, can we acquire quickly? And if we like the answer to those questions, we'll go pursue it with a single-threaded team that isn't distracted by the rest of the business.
When it comes to the stock, it has fallen significantly. Do you think investors are missing something, or has tech just been overvalued?
I have never tried to predict what the stock's going to do. And any time I've tried to a little bit, I've been wrong. I do really believe that in the short term, the stock market tends to be a voting machine. In the long term, it tends to be a weighing machine. We have a concept we talk about a lot at Amazon, inputs and outputs. And the ultimate output for a company is share price. And then other big outputs are free cash flow or profit or revenue. You can't really manage the outputs. You have to manage at the input level, and that's where we spend all our time. And so if you do the right things for the business long term, things tend to work out. I think we've had very good returns for investors, and I expect that to be true again.
Material samples brought back from objects in space can shed light on billions of years of our solar system's history, including details about the origin of life here on Earth.
A piece of an asteroid is a piece of the earliest beginnings of the solar system.
But picking up rocks from the surface of an asteroid or planetary satellite isn't as easy as it sounds. It requires voyages of millions of miles to bodies that have never been seen up close. Probes need to land on surfaces with weak gravitational pulls, where the surface terrain is completely unknown, gather samples, and then make the long trip back. And while behemoths like NASA and SpaceX grab headlines, it's a relatively young space agency. The Japan Aerospace Exploration Agency, better known as JAXA, that is taking the giant leap necessary to bring the mysteries of space back down to Earth.
Strong enough to stay, we will never.
I'm not sure that they actually need to respond to anything here. I mean, they're trying to stabilize a market, but I grew up in an environment where we were told that markets were efficient. And so I understand it's only temporary, but I'm not sure that the BOE is doing the right thing.
One of the high points of this special edition of Bloomberg Surveillance, an historic day for the United Kingdom and worldwide, intervention, rate rises in the air, and of course the uncertainty nation to nation about monetary policy. Katrina Dudley with Franklin Mutual, she was just lights out. It was just a great, and Lisa, we just got to say our team literally blowing up the show today has just done a great job.
We have an amazing team, and we're grateful to them.
I called them up and I said, please, we've got to go to the Dartmouth bubble to speak to David Blanchflower, of course, professor of economics at Dartmouth College, his experience at the Bank of England, and a student and a doubter of a fully employed United Kingdom, a fully employed America as well. There he was, David Blanchflower, John Major at 79 years old, coming down the aisle at Westminster Abbey for the Queen's funeral. And I've always adored the straight-talking Norman Lamont, now 80 years old. In 1992, I will editorialize, "They did not hide." Where is Liz Truss?
No idea. We've no idea where Liz Truss is. We've no idea where the Chancellor is. Tory MPs are hiding, and every news organization is trying to get ministers to come on and talk about the chaos that's reigning. So the fact that they're hiding is a really bad thing. And today's a big anniversary as well, not just 1972, but 28th of September 1976 was when Dennis Healey went to Heathrow Airport and the markets collapsed so much he had to come back to Downing Street, go to the IMF, and the IMF has intervened in the last 24 hours saying, you know, you've got to reverse these policies. So we're seeing chaos in the markets. But the numbers of us warned, I wrote a whole series of columns warning that this was coming a month ago, saying, you know, the problem is the markets will actually prevent amateurs doing stupid things. They haven't prevented it, but now we're having to see these organizations intervene, the Bank of England, but we are now in chaos.
Danny, the students at Dartmouth that want to get a quality C with you are forced at gunpoint to read the appendix of the Green Book of the IMF, their financial stability book. Explain for our radio and television audience worldwide what the Bank of England does to study financial stability, including the stunning headline an hour ago that they're worried about collateral calls on the gilt market. Explain that mechanism at Threadneedle Street.
Well, I mean, it's in a sense, the story that I know, the book was thrown out last week. So what we saw was a statement by the governor of the Bank of England, who does not say, I'm sorry, I have to take it away.
That's okay. That was just the prime minister. Don't worry about it.
It was probably, I've had so many phone calls. So the statement of the governor of the Bank of England, which caused markets to crash again, the MPC doesn't set monetary policy. The Bank of England actually and the MPC actually does. Right. So what we saw today, I mean, it's in a sense, I can't answer your question, Tom, because today what we saw was a monetary intervention that presumably the Monetary Policy Committee should have done, but the statement says this was not a meeting of the MPC, this was financial policy meeting. I really don't understand. I mean, in a sense, the book says the job of this, I mean, I remember going to the MPC and I was told monetary policy is meant to be boring. Monetary policy is meant to calm nerves. In some sense, the intervention today was about that. It was about trying to calm nerves at the top end of in the long-term yield market. But I mean, we saw that they've also said, I don't know quite how the FBC said it, that the Bank of England is not going to do quantitative tightening this week. So the answer is the book says calm nerves, be stable. And it says the same thing to the Treasury. But none of that has happened. So I'm afraid the answer to your question is all of that was probably true a week ago. But today we're seeing, the economics of pandemonium.
The economics of pandemonium. I like that. Danny, if you were on the Bank of England committee right now, what would you opt to do?
Well, you asked me a question last week, and you said to me, would you ever vote for a rate rise? And I sort of said, well, of course. But last week, I thought that wasn't the right thing to do. I actually think that I would have banged on the governor's door today, and I would have said, we have to have a monetary policy committee meeting. And basically, we probably have to raise rates. We have to raise rates by 100 basis points. We have to stabilize the economy. Somebody somehow has to step in there and be the NPC member. You say, well, I want to sit here and talk about this. You could certainly persuade me to vote for a 100 basis point rise. But, Lisa asked me last week what I said, of course I would, but I would. But it's, a week's a long time in the economics of pandemonium.
Yeah, certainly in this very moment. We just have about a minute, but your perspective going forward of the potential for some sort of politicization of this Bank of England at a time when if they were to raise by 100 basis points, it could really torpedo household balance sheets with mortgages that are tied to that rate.
Well, absolutely, Lisa. And I think, in a sense, the big story is over the last 2 days, we've seen all the mortgage lenders in the UK basically backing off. We've taken out their products in the markets because they can't price mortgages because of the chaos. So if you're in a position where you as a chancellor have actually ended up closing markets, I don't know, somehow or other, calming has to come. But there is going to be and the rise in house price, the rise in interest rates is going to kill the housing market off. The UK was probably already in recession. It's been driven into recession by this utterly incompetent set of moves by the chancellor. And I don't know what he can do. I'm not sure I know anything that he can do.
Right.
It's not clear to me. I mean, if he resigned, what are they going to do? I don't know what he can do.
Danny, we didn't have you on to talk about the Bank of England. How are you going to do down in Florida with a hurricane? Are you going to lose all your great fishing spots?
My house is sitting on Sanibel, and I just heard as you came on here, the hurricane has moved and is heading right at my house. So that's not good.
I'm so sorry.
Yeah, it does not look good. It's headed right at us.
We've heard from David.
The island has been. The island has had mandatory evacuation. This is not good for us.
We have heard this from David Kotok and others as well in Florida. David Blanchflower, hope that you do well in Florida, and thank you always for perspective from Dartmouth College as well. Lisa, just an absolutely extraordinary day. Can you help me and sum it up?
The economics of pandemonium. I really like that. I think that sums up the day. The whipsaw move that we have seen on the long end of the gilt curve, the 20 to 30 year spectrum as people take a look at some sort of stabilizing move from the Bank of England.
Well,
how do you get confidence in a market that is supposed to be deep and is supposed to be the credit of a major nation?
The future's up 9, the VIX 32.75. Please join Bloomberg through the day. On radio and television, Mohammed El-Arian will join from the University of Cambridge in a bit. Stay with us. This is Bloomberg.
When you think of cutting-edge technology at sea, you might be thinking of stuff like this. But there's an incoming revolution on the high seas that isn't quite as sexy, but could be significantly more impactful.
Container shipping is the key component of global trade. About 80 or 90% of all the world's goods are transported at sea at some point.
But there's a significant unseen cost to the modern era of global commerce.
About 3% of all the world's CO2 emissions come from shipping.
3% may not sound like a lot, but that's roughly comparable to the entire CO2 output of Germany. Since reducing trade isn't a likely option, what about a technological improvement to help reduce the emissions from these well-stocked maritime behemoths?
Markets are preparing to close, but the day is not over yet.
Stock that is now up about 45%.
A lot of volatility right now.
You need the power of the Bloomberg terminal to get you market-moving data before anyone else.
These numbers are much higher than expected.
Upgraded today to overweight.
You need top analysts to bring you exclusive global insight into cross-asset markets.
The muni bond market.
China is a really big focus.
Bitcoin ain't playing along today. It's going to be short-term.
Bloomberg Markets, The Close, weekdays on Bloomberg.
When you've had your fill of IPOs, ETFs, and CPI,
tune into the lineup for some NFL, NBA, and MLB. Did you retire too early? I mean, look at some of these payouts.
I absolutely retired too early.
For the inside scoop on sports betting, catch the lineup right here on Bloomberg.
Enjoy the excitement of a night of music at Boston Symphony Hall with BSO Now. Watch brand new Boston Symphony Orchestra performances, behind-the-scenes storytelling, and memorable archival concerts, all from the comfort of home. Use our free 24-hour trial and see why the Boston Globe calls it musically rewarding. And the Berkshire Edge says the orchestra has never played better. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
What a morning. Good morning, good morning. Just about out of breath. Your equity market, just about positive. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
From New York, we begin with the big issue, central bank intervention.
This is an extraordinary situation.
Clearly, the Bank of England has got a problem.
I'm pretty critical with about the actions that we've just seen here.
I'm not sure that they actually need to respond to anything here.
The Bank of England is effectively adding more liquidity into the system.
In Asia, we've had India and the Philippines intervening, Bank of Japan intervening.
But I'm not sure that the BOE is doing the right thing.
No doubt we are seeing dysfunction in the markets overseas.
This essentially EM-type price action in the United Kingdom.
The price goes up, the price goes down, and the price is always responding to news.
You're talking about global markets moving 20, 30, 50 basis points off of one data point or one policy announcement.
I understand it's only temporary.
But if anything, this places more pressure on them at the front end of the curve.
Just an extraordinary situation.
We're not quite sure where they're going.
The Bank of England stepping into the gilt market, writing in a statement the following: the bank will carry out temporary purchases of long-dated UK government bonds to restore orderly market conditions on whatever scale is necessary to affect this outcome. Out of London, a good friend of this programme, good friend of mine, Guy Johnson, joins us right now. Guy, what is going on this morning?
The Bank of England has had to respond, I think, to a number of phone calls that have been coming through from the pension industry, from the defined benefits pension industry, which is basically an industry that is now facing chaos, margin calls, and there was a serious concern that were that to escalate, you could see a significant crash in gilt prices. They've stepped in to avert that. This is an FPC decision. This is an MPC decision. So this is a financial stability decision, not a monetary policy decision that is being made here. It is basically designed to attempt at least to stabilize that key and critical portion of the market. What it hasn't done, John, is remove the need, according to many in the market, for a significant rate rise from the Monetary Policy Committee, and it hasn't had a massive impact in terms of the swaps market, where mortgages are priced from, which is what a lot of people are panicking about in the UK. Now, I'm looking at the 2-year swaps, the interest rate swap over the last 3 days, actually. It is beginning to roll over a little bit now, but we are still at very elevated levels.
Guy, next scheduled meeting, November 3rd. I chose my words carefully there. Scheduled. Can they wait that long?
It depends on a number of things, John. A number of things could stabilize this situation. You could see, obviously, action from the fiscal side. The government could change tack, listen to the IMF, I don't know. But you could see something coming from the government which would help to stabilize the situation. In the absence of that, then increasingly the view is that they probably can't wait that long, that we need some sort of economic stabilization here that needs to come from the MPC, and that probably means, I was listening to Danny Blanchflower a few minutes ago, that probably needs a significant rate rise. That is certainly what the market is still signaling at the moment. You look at what is happening with sterling, you look at what is happening with the rates market more broadly, that is what is being signaled right now. What they've done today is put a sticking plaster over one bit of the market that was facing a crisis.
Guy, there's plenty of questions about whether it was facing a crisis. They say they're doing this to restore market functioning. Was there anything dysfunctional about what we've seen in the gilt market? We've got yields down today by 100 basis points at the long end in the UK gilt market. What was dysfunctional about the last couple of days, Guy?
So, I think if you take a step back, you look at the scale of the moves. In isolation, as long as the market is functioning, the scale of the moves are almost irrelevant. I know that's not quite true, but the market was in some ways functioning, trying to set a price, a clearing price that international investors in particular could accept. I think the issue here was that there was a particular kernel of the market that was dysfunctional, and that was within the rules, heavily rules-based system that exists around the defined benefits pension industry. And I think that's where the real dysfunction was, and that is why the bank has stepped in to do what it has done today. It has not solved the price dysfunction. It has solved the problem that existed at the long end. Yesterday, as I left the office, the 30-year was just rocketing higher and higher. That is where the pension industry lives. That needed to be fixed. That was dysfunctional. Now they've got to address the rest of it. This is a job quarter done, half done. It is by no means fully done.
Guy Johnson, out of London. Guy, thank you. The long end of the gilt curve, we're down 100 basis points on a 30-year to 397. On a 50-year, we're down 105 basis points to 360. Now, what you witnessed through this morning was a surge in the gilt bond market, yields aggressively lower. Sterling still weaker on the day, though it's off the lows. We're down about 0.7% at 106.60. Joining us now to discuss is Tall Bankers Michael Purvis, Mona Mahajan of Edward Jones with us as well. Mona, we're seeing central bank intervention a whole lot more from the BOJ in the past couple of weeks, from the Bank of England this morning. Is something breaking here? Do you think, Mona, that this Fed needs to pay more attention to?
Yeah, thanks, John. You know, I think this was always the concern of markets and investors when the Fed was moving so aggressively higher, 75 basis point rate hikes, unprecedented, moving towards a 4.5% terminal rate. Haven't seen those types of levels really since 2008, 2009. And so what we're watching for are these exogenous shocks. Now, the good news, or the silver lining perhaps, is thus far we are seeing it in currency markets. We're seeing it in international bond markets, perhaps to some extent in the emerging market space as well, which is feeling a lot of this pain that Jerome Powell has been alluding to. Now, here in the U.S., keep in mind, our credit markets have been functioning in a relatively orderly fashion. We have seen credit spreads widen, but nothing close to what we would call panic or distress levels. We have a banking system and a financial system now that is much more sound than what we saw back in 2008, the great financial crisis. And of course, we are an economy that's somewhat more resilient to foreign oil markets, a labor market that's still pretty sound. So the fundamentals are intact, but some of these cracks we're seeing that are emerging internationally and globally, the risk is really, can they become domestic problems as well?
Michael Purvis, I would just want to get Michael Purvis's view on this as well, Mona. Michael, what's your view on this?
Look, we're looking at a Fed that's gone through one of the most massive transformations just in the last 12 months. And, you know, last year, dollar strength was a very quiet sort of backstory, if you will. And even through a lot of the first half of this year, now it's sort of really emerging as as sort of a key sort of macro problem. And of course, there's always two sides to the FX story, what's happening in the US and what's happening over in the UK or Europe and so forth. But I think this is going to be a very enduring thing that's going to underscore risk appetite or be a challenge for risk appetite, regardless of what kind of economic and earnings data we get here. If you're looking at the yuan, it's just now decided to break through to fresh lows against the dollar. That's another sort of facet of this thing. And so the Fed has of course gone aggressively after inflation, but the second order impacts there, of course, enhanced by what's going on in policy in the UK, your country there. But it's going to underscore very high FX volatility, and that is ultimately not constructive to get a sustained bid in risk assets.
Mona, I can't keep up with central bank policy. First it was QE, QT, and we're calling this morning quantitative confusion. What on earth is going on with policy abroad? 1 minute they're going to be selling gilts, and now they're buying it until the middle of October.
Yeah, this is really a classic sign of perhaps there is some dysfunction in credit markets that the central banks there had access to that maybe the rest of us hadn't seen. And they got to a level of concern where they did have to step in and create a little bit more order in those markets. Now, keep in mind, markets here reacted somewhat positively because ultimately the hope of investors is that at some point our Federal Reserve also pauses, perhaps also steps in with more easing. What they're doing in the Bank of England is essentially providing more liquidity, essentially creating a bid for these assets as well. But I think the differential, of course, is that as we noted earlier, thus far we are not seeing any disorder in the U.S. credit markets, and thus far no reason for the Federal Reserve to make any sort of similar pivots or moves. That being said, I think the Fed is watching very closely what's happening abroad, what's happening domestically in terms of more and more calls for slowdowns, economic downturn, recessionary conditions. I don't think they want by any means to push the U.S. into some unnecessary, deeper, prolonged recession either. So it is on their radar, but not ready to step in yet.
Do you think that this equity market could well be unbuyable until this Fed witnesses the whites of the eyes of recession?
I think it may be range bound until we see a pause in this Federal Reserve rate hiking cycle. Now, keep in mind that implies that yields have to kind of stabilize as well. In the U.S., we've been seeing a 10-year close to 4%. We need to see yields stabilize, perhaps even start to move lower before we can get a sustainable rally. And then, of course, the big story this year was the inflationary pressures. Now, the good news there, we're starting to see commodities, headline inflation perhaps roll over, but we all know the story on core inflation. It is stickier, although the underlying housing market and perhaps even the labor market is softening. So we could make a more credible case for inflation having peaked and starting to roll over. What we're waiting for is a yield story to catch up as well.
And Michael Purvis, we've been waiting for this Federal Reserve to pivot, to pause, to do something, whatever, through much of this summer. Hasn't happened. I've been questioning whether a Fed pause would even be bullish. Michael, would a Fed pause be bullish if they're just doing nothing in a recession when we've been so used to them cutting when they see pain?
Look, if they get another 75 and another 50 done, and then pause there and kind of articulate that we're going to just probably stay at these levels for some time, right? Then probably that's going to bring down some of the extreme rate volatility that we've seen there. If they can articulate that this is sort of our new strategy, is not to just hike and then cut, but kind of like bring it up to a healthy level. And then sit back and watch, hopefully, inflation continue to contract, then I think that would be a condition where equities could get bid on a sustained basis. But I think that's we don't really know what it's going to do right now. You saw the setup coming from the CPI print into the FOMC last week. It was a very clear setup that, with a 10-year about to break in through key technical levels, that they didn't care about breaking those things. I do think that you're probably going to start seeing, if we get a soft inflation print, I think it's October 13th when the September CPI comes out. If that print is soft, you could really start seeing a much more constructive environment there. I just don't know how sustained that condition is going to be, because a soft CPI could be followed by yet another hot CPI, and the Fed doesn't know how that's going to play out either. So I think there's going to be a fair amount of uncertainty one way or the other. That doesn't mean we can't have a strong rally, a tactical rally into year-end either.
Michael Purvis, Mona Mahajan, to both of you, you're going to stick with us. Equities right now just about negative on the S&P, down almost 0.1%. Coming up, the administration, the White House, sticking with its optimistic outlook for the economy.
There's no certainty in any way, or no way inevitable that we are, we're going into a downturn.
That conversation up next.
About what they call black soot caused by the manufacturing and consumption of these fuel products in the illegal refineries.
Oil theft, known as bunkering, and the refining of its spoils is worsening the damage from decades of fossil fuel exploitation, creating one of the world's most severe ecological disasters.
Our sacred forests, our homes have to give way to oil wells, and no one gets much benefit.
Imagine a resident of Port Harcourt who inhales this soot every second in 24 hours, 7 days a week, 30 days in the month, and for years now. We are dying slowly but surely, and our lifespan is reducing every day.
Possibility of a global accord to kind of adjust currency values the way there was with the Plaza Accord, or is that just not something you're focused on?
I don't anticipate that's where we're headed.
The White House National Economic Council Director Brian Deese does not expect another Plaza Accord. This as the dollar eyes a seventh day of gains, touching another record high. The dollar index at 114. Secretary Yellen saying there's no cause for concern, telling reporters we haven't seen liquidity problems develop in markets. We're not seeing the kind of deleveraging that could signify some financial stability risks. Markets are functioning well. Bloomberg's Anne-Marie joins us now from D.C. AMH, those two individuals I just mentioned, Brian Deese and Secretary Yellen, will they be in this administration in a few months' time?
Well, I think, one, the message in terms of what's going on in the markets for the administration, you look at those comments, is really nothing to see here, right? The U.S., they say, is shielded from some of this pain going on, or they think their economic agenda will help them shield it. And Jonathan, when it comes to these two individuals, there's lots of rumors that have gone around, specifically for Secretary Yellen. She was asked one of the first times in December 2021, not even a full year into the administration, if she plans on sticking around. So this rumor comes around a lot, and especially it comes around a lot when it comes to midterm elections, right? Will the president look to make some reshuffling after a midterm election? Right now, what we've heard from these individuals, from the Treasury Secretary's spokesperson, as well from Brian Deese himself yesterday, is that they plan on staying there. Brian Deese's quote was that he's really in the thick of it all and wants to absorb everything the administration is doing right now.
Your thoughts on what's happening in the housing market with mortgages and mortgage rates approaching 7%, in some cases going through it, AMH, how are they responding to some of this? Are they still comfortable with what's going on around them? Do they still just say the Fed's got space to do the job they need to do to bring inflation down?
I mean, they point the finger to the Fed. More of Secretary Yellen's comments when she was speaking to reporters in North Carolina was the fact that she said that around the world, central banks are fighting high inflation, barring really China, and that they're doing it at their own time and pace, and that is why you are seeing what we are seeing right now in the financial markets. When you ask the administration about their concerns about the economy, and reporters did ask this to the press secretary on Monday, she talked about the fact that the president had talked to his economic council on Friday, and what they had told the president, it was that their vision and their strategy for the economy, which is long-term growth, investment, manufacturing jobs back in America, they believe is working at the moment. So when I say they're really saying nothing to see here, they're really pointing the picture to what they think is working for the United States and saying at least we're not dealing with it as bad as, say, Europe or the United Kingdom, which is what Deese also said yesterday evening.
AMH, thank you. Anne-Marie, down in D.C., just on the housing market, mortgage rates this year in America have doubled. We had an index of 20 cities coming out in the last 24 hours, posting the first monthly decline since 2012. It's not just the US, we're seeing it in the UK as well for different reasons, that mortgage deals are getting pulled left, right, and centre. Michael Purvis, Mona Mahajan, joined us right now. Mona, what about this is desirable in the Fed's eyes, and what about it is undesirable as we start to see the brakes get hit a little bit harder in this economy?
Yeah, absolutely. You know, look, on the desirable side, to your point, I think what they're really seeing is the slowdown in housing and potentially the slowdown in the labor market that they've pointed to will ultimately lead to a slowdown in CPI, and especially that core CPI we talked about earlier. We know shelter and rent components of CPI, which make up about a third of the basket, tend to operate with a lag impact. But in a 6 to 12 month period, we should start to see this disruption in housing start to flow through. Now, on the downside, of course, one of the more structural components of the market that we will be watching is the housing market. You know, if we think about where we could see really breaks in the economy and where we could see notable disruptions, I think housing is one of them. Of course, the other part of the story that they'll be watching closely, their move to a 4.5% terminal rate has really created, perhaps more so than ever, this base case among investors and markets really reflecting a recession rather than the discussion around whether we could reach a soft landing. So I think generally speaking, what now markets and investors will be thinking about is when will this recession occur and really how deep or how long can we expect it to last? Now, in our view, I think we still don't see yet the scope for a deep or prolonged recession, but you know, the exogenous shocks that we're starting to see in global markets, harder to handicap if or when they may arrive on domestic shores. But for now, I think the base case remains for a average, shallow, modest recessionary environment, probably sometime in early 2023.
Michael, are you comfortable with that assessment? The Fed has hiked 300 basis points in 6 months. In the last cycle, it took 3 years to do 225. Given the lags in policy, the tightening that's already in the pipeline, isn't a recession of some degree just already baked in? And does it have to be a short and shallow one?
You know, I think there's, it's hard to have high conviction on severe versus mild recession right now because there's a lot of good arguments you could make reading into the future, just extrapolating some of the impacts here of this policy, the lag effects on these policies. Of course, we're going to have some real economic problems next year. On the other hand, when you look at, you know, the economic bear case that's been articulated over the last 9-12 months, you know, you still see ISMs in the mid-50s, right? You still see employment data very robust too. It's a very, very strange cycle. So it's kind of really hard. I know it's a cop-out answer there, but frankly, it's a sort of hard case to really handicap. And there's a lot of, for all the bad things that are likely to come, there will be, and there are a lot of them. You know, there might be a lot of upside surprises there too. You know, there's a lot of ex-US sort of recessionary conditions that are coming into play. What happens if China starts stimulating after November's Congress and so forth? What happens if you know, things are, we get a decent GDP picture, with some ebbing inflation. We've certainly had some horrible inflation prints there, but if that reverses and the ISMs hold up and the participation rate in the employment data starts improving, maybe you really do have a good condition there. So I think but that's a lot of uncertainty there, and I think that uncertainty is going to keep risk appetite at bay here. And I think there's so many people who are going to keep parking themselves in those one-year Treasury bills or pretty secure investment grade paper, to sort of let me just camp out in short-term yields.
That's what we're seeing.
Yeah.
Everyone seems to be doing the same thing right now.
Yeah.
Seeing it at the front end of the yield curve today, we're down 13 basis points on a 2-year. Michael Purvis and Mona Mahajan, thank you to you both. The former Fed president of New York, Bill Dudley, caught up with us yesterday after writing a Bloomberg opinion column. This is what he had to say about the Fed and Fed pain and the potential that this Fed is underplaying the economic pain from the Fed effort. What will happen when people realize that the job will be harder, the pain greater than the Fed has indicated? Support for its policies will probably decline and it will probably lose credibility. Bill Dudley went on to say something crucial to retain to get inflation under control. Something to consider. Coming up, the morning calls and later, demand woes, keeping Apple shares lower. We'll speak to Dan Ives of Wedbush at the opening bell.
Imagine simply climbing a cable into space. The concept is known as the space elevator. Not only could it significantly change how we leave planet Earth, but it could also completely transform humanity's relationship with space. And there are scientists who think we could have already built it.
We have the material, we have the technology, we have the lasers, we have the climbers, we have all of it. If a private entity wants to build it, or a government, they can build it. It'll change society. We have no clue how colonizing into space, how really spreading out into space will really change our society over the next 50 to 200 years. It'll be completely different.
Innovation, money, and power collide in Silicon Valley and beyond. Bloomberg Technology with Emily Chang. Weekdays at 5 p.m. in New York and 2 p.m. in San Francisco.
Minutes and about 15 seconds away from the opening bell. Equity futures recovering positive 0.4% on the S&P. That's the price action. Here are your morning calls. First up, Wells Fargo downgrading Lockheed Martin to underweight, seeing a challenging year ahead due to weaker defense spending. Atlantic Equities upgrading Netflix to overweight, expecting its new advertising service to fuel a leg higher in shares. And finally, Morgan Stanley reiterating its overweight rating and 180 price target on Apple, saying the production headlines are more bark than bite. That stock's down by 2.6%. We'll talk about that with Wedbush's Dan Ives, expecting Apple shares to remain in the penalty box until October's earnings report. The opening bell just around the corner. Equity futures just about positive. Yields coming in from New York. This is Bloomberg.
the satellites have propulsion systems. They can kind of move to get out of the way of each other or change their orbit a little bit. It's a service that you guys offer to help these companies know how to maneuver their machines.
Yeah, we offer a collision avoidance service. It's a subscription service. We'll send you an alert up to 7 days in advance if your satellite's going to come dangerously close to a piece of debris or another satellite.
Companies have been doing that for decades, moving satellites around, but it's sort of like a harder problem now.
The risk of a collision is a lot higher now, just because we've installed so much more hardware into space. You have a big collision, it creates a cloud of debris, and now all the other satellites are flying through this whizzing mess of debris. As we add all of the new satellites into space, the risks of the collision, the likelihood of the collision is going up.
The difference between endless research and a winning strategy. To improve your firm's productivity and profitability, Bloomberg Law combines the latest in AI-powered tools and in-depth analysis to accelerate the research process. To grow your practice and make better use of your valuable time. The difference is Bloomberg Law.
You will shed light on dark matter. You will make aging optional. Because when you subscribe to Bloomberg, you won't just get news. You will get insight into limitless possibilities. Before you change the world, Bloomberg.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia.
This is Bloomberg Technology.
Welcome to Bloomberg, the lineup.
Coming into Wednesday, 6 days of losses on the S&P 500. 6 days of losses and going back to lows we have not seen since November 2020. It's been a while. Equity futures right now positive 1/3 on the S&P. On the Nasdaq 100, just about unchanged. Bouncing back from where we were this morning with yields breaching 4% briefly. There's the opening bow, switch at the board and get to the bond market. It's a turnaround engineered by the Bank of England, not the Federal Reserve. The 10-year down by 13 basis points, 381 on a US 10-year. What a range already this morning after going through 4%. Briefly, over in the UK, gilt yields absolutely crashing. In some cases, down by about 100 basis points. In the FX market, dollar still showing some strength. Euro dollar 95.86, negative 0.1%. Pound sterling negative 0.7% at 106.56, and crude up by more than 1%. 79.43, just short of 80. Let's get you some movers around the opening bound about 30 seconds in. Here's Abby.
Well, John, we are looking at the first up day in 7, the breaking that, snapping that longest losing streak going back to February of 2020. And the gain would be bigger for the S&P 500 if it weren't for Apple, down 2.5%. This, of course, as the company has said, that the demand is weaker for its new iPhone, so it has told suppliers to cut production by as many as 6 million units for the second half of this year. They thought that that iPhone 14 would really spur a surge in demand. That has not happened, although one positive is there's more demand for that Pro Plus rather than the low end. Now, Skyworks and other Apple suppliers falling on this, not surprisingly. To the upside, though, Biogen right now popping more than 40%, heading to its best day for quite some time. This, of course, as its Alzheimer's drug, a breakthrough trial, sets the company up with its partner for FDA approval. Lots of Wall Street banks have upgraded, and it's the best day going back to, you were just speaking of November of 2020, since November of 2020. And then finally, oil. We do have Chevron higher, with oil going higher as well for a second day in a row, up 0.7%, John.
Abby, thank you. Let's turn back to Apple, down about 2.5% in early trading. Ed dropping by to get us up to speed. Ed, what's going on?
Yeah, it's a cautionary tale in resetting expectations at the last minute. As Abby said, you know, sources had told us Apple went to its suppliers ahead of the iPhone 14 release in anticipation of elevated demand and said, let's go from 90 million units this year, 2022, which mirrored 90 million units in 2021, and boost it by 6. Now they're walking that back to the original 90 million, and you can see the market reaction. Apple at a July low, down 2.5%. Interesting, though, John, by the way, see the NASDAQ in positive territory, despite that drag from Apple, given its weighting. As Abby said, some suppliers had pivoted to adjust their production, at least one source tells us, to accommodate for that demand for the higher end iPhone 14 Pro models. What are they going to do if that does not sustain? You see the reaction, key suppliers dropping. Qualcomm, for example, lower in early trading. Around a quarter of Qualcomm's revenue comes from Apple. It's a key maker of the modem that goes into those phones. So we're feeling repercussions around the world. Why do we care? Because we look to the smartphone market to get some kind of read on the strength of the consumer, particularly in China, where Apple drives 20% of revenue. Either way, we're kind of back to square one, 90 million units this year.
Ed, thank you, buddy. As always, in the penalty box. That's what Dan Ives of Wedbush has to say. Here's the quote from him. The overall iPhone 14 demand story for Apple is steady, but clearly not the home run success out of the gates, as consumers are not paying up for the base model in a softer macro environment. I'm pleased to say that Dan joins us right now. Dan, last time we spoke, and it wasn't too long ago, you said so far demand and orders for iPhone 14 are tracking slightly behind iPhone 13 and are tracking ahead of our expectations out of the gates. Dan, what didn't you see? What went wrong?
Well, I think you really have to separate, as Ed talked about, between iPhone 14 Pro and the base model. Pro continues to track 8 to 10% ahead of iPhone 13. Based on everything we see, and I think you'll start to see production around that starts to ramp. In terms of the base model, I mean, that's been underwhelming. I mean, that's really the 6 million units, and that's obviously going to be a jolt to the street. But I still believe overall, when you put it all together, the overall demand story with iPhone Pro, that's the key, is better than the street's expecting.
Dan, based on how we're readjusting today and going into earnings in the next month or so, are you expecting then potentially weakness on revenue, but some upside on earnings given a better average selling price?
Yeah, I think the ASPs are so strong on Pro. I mean, the mix shift we think is 85, 90%. So I think that will be enough that we still believe, take out FX a beat in terms of the quarter. In terms of going forward, look, 90 million units, that was the line in the sand. I think the worry that they were actually going to cut 3, 4, 5 million off the 90 million units. And I think as this continues, specifically Pro, if it goes into holiday season, I believe they will start to increase production again, specifically on the Pro.
Dan, when was the last time this company had a real cyclical test for this iPhone? And I don't think the pandemic counts given the fiscal transfers. When's the last real cyclical test this company's had for the iPhone business that we can look back on and see how it performed?
You'd have to go to 2016, 2017 in terms of, and there were specific product issues that they were dealing with. But if you go back since the 2007 launch of iPhone, right, just given the ultimate install base now, it's about 1 billion iPhones, they've been able to withstand economic pressures because of that install base, because of the upgrade cycle. And this clearly, for Cook and Cupertino, it's a huge test to see if they can navigate the storm with basically unprecedented things that we haven't seen in some cases since 2009.
Dan, final question. We talked about this last time we spoke. I think it was my final question then. How would you know if you're wrong?
Yeah, the main way we know we're wrong is if we start to see wait times significantly come down for the Pro. We see specifically in China, any sort of weakness going into call it December. If that happens, then the story changes. But for right now, we're not folding on our bullish thesis. It continues to be on Pro, but clearly Apple underestimated on the base model. That's been very disappointing.
Dan Ives of Wedbush. Dan, thank you. The stock is down a little bit this morning. The S&P 500, the gains since the onset of the pandemic, trailing inflation in the United States. Let's bring in Taylor Riggs for more. Hey, Taylor.
And John, you're looking at it as sort of an unchanged S&P 500. So if you get losses today on the S&P 500 and close at that, you're looking at 7 straight days of losses. That is the longest losing streak on the S&P 500 since February of 2020. And the losses haven't been insignificant. In some days, you're really looking at maybe 0.5 or even 1% decline. So getting that a little bit under pressure today. The interesting story is also within the bond market. John, overnight, of course, you had a 10-year that touched 4%. Of course, now we migrate back downwards to about a 3.83. But the point here has been a 10-year yield that actually is relatively attractive. I'm going from Tina to Tara. There is a reasonable alternative relative to that dividend yield, right? When you think about the opportunity that closing in on 4% on a 10-year yield actually represents in this market. Finally, take a look at sort of the next board when we think about full capitulation. Gina Martin Adams is saying that instead of maybe half of the indicators looking at full capitulation of what we had in June, a lot of maybe now 75% of those indicators, including the VIX, are pointing us more towards a bottom. When you think about an accumulation of finding a bottom in this market, a VIX that hovers above 30, around 33, is one of those signals that she's looking at.
Taylor, great work, thank you. Just unreal, just to see the S&P 500, not today, but yesterday at the close, back to lows we haven't seen since November 2020, and getting close to wiping out all of the post-vaccine gains from the pandemic. Unreal. The S&P down another 1/10%, the Nasdaq down by 0.4%. John Hancock's Matt Miskin expecting a recession to drive the Fed's pivot, writes the following: the central banks are the ones breaking things across markets and economies. We see a recession starting in a couple of months and lasting into 23. The Fed funds rate could even go back to 0% lower bound because the Fed will need to do all the heavy lifting to get us out of the next recession. Matt Miskin joins us right now. Matt, let's go there. Back to zero. Really, how quickly?
I mean, what's going on in the bank with the Bank of England and with what's going on with the UK right now is a great example that fiscal policy cannot be the lever to get a counter-cyclical measure to get economies out of recessions. If you're doing all this fiscal spending right now, the cost of capital has gone up so much that the interest burden for these countries are going to be so significant that the Federal Reserve or the central bank is going to have to be the counter-cyclical measure. And I think if we're not going to get all the fiscal stimulus we've gotten out of these last recessions, then the Fed's got to get us out. You break it, you own it. And the Fed is breaking things right now, well, they got to own it. And that means they're going to have to be cutting aggressively once we get into this recession.
Where would inflation be in that recession, Matt, and why are you convinced they're still going to cut?
So inflation, in our view, is coming down because you look at, copper prices, lumber prices, oil prices. Then you look at the housing market. Housing market, it takes forever, it feels like, for that data to show up in the consumer price index because of the way that it's calculated. But nonetheless, month over month, housing prices are likely coming down significantly. And look, it's a risk, inflation right now, I get it. But at the same time, the Fed has already injected a lot of tightening into the system. Monetary policy works with a lag. We're not even going to feel all this until the beginning of next year, into next year. That should really dampen demand, which unfortunately will dampen, or fortunately, will dampen inflation, but it's tough to just decrease demand like this.
So, Matt, let's just say you're right. And I'm sure there's some people shouting at the screen. There always are, saying you're wrong. But let's say you're right. How tradable is this call? How tradable is it?
John, I mean, Taylor had, you get the CFA charter holder here, and you're now coming up with new acronyms about, Tina's gone, and now we got Tara. I mean, this is what this market's all about, right? But there is alternatives. There is, and if we can get 5-6% yields almost on investment grade bonds, and then potentially see price appreciation going into next year. And look, it's tough right now. I get it, but we're seeing the tipping point where central banks are tapping out, saying, look, we can't have yields go up this fast. And when that starts to unravel, when that starts to turn, and we think the Fed is going to have to follow suit eventually, because if the dollar goes up like this forever, or for an extended period of time, it's going to make it very hard for us to be competitive. And, at the end of the day, that's going to result in the Fed cutting eventually next year. We think that's going to result in price gains and income, which is going to be really competitive return from bonds into next year.
Matt Miskin, just finally, you understand better than I that there's a big pivot and cutting all the way back down to the zero lower bound. Aggressive, Matt.
Well, it's a sequence. The sequence. Next year, they're going to be cutting. And, at the end of the day, right now, we're saying short-term duration, intermediate duration, and then into next year when they start cutting longer duration. And that is actionable, and you get paid to wait. We get paid, again, on investment-grade bonds now, it's about 5%. We think that's going to be very compelling income while you wait for that price return coming out of the bond market into next year.
In 6 months, can I replay this clip to you? Are you happy me doing that? In 6 months from today. John. This is the timestamp. All right. Matt Miskin. All right. Thank you, sir. Appreciate it. Coming up, a busy week of Fed Speak continues with Chair Powell on deck.
have to balance that off with our dual mandate with full employment, and trying to navigate that to bring inflation down while we do so as gently as possible is a struggle.
We'll get the views of Mohammed Al-Arian very shortly. From New York, with your equity market just about holding on, and your bond market yields lower by 12 basis points on a 10-year after seeing 4%. Already this morning, we're back down to 383. Just wild stuff. From New York, this is Bloomberg.
Politics. From the White House to the Hill, Bloomberg covers the leaders in legislation.
That was really a tectonic shift for this White House.
The theory of this bill, as I understand it, is there'll be a multiplier effect. How did Democrats mobilize specifically younger voters?
Bringing you the political news you need to know.
The president has made it very clear that this is a significant focus.
For the intersection of Wall Street and Washington, nobody covers politics like Bloomberg.
What do Formula One cars and your local supermarket have in common? Well, strange as it sounds, they might both be using the same technology. A lot of innovation has trickled down from the world of high-tech engines, and it hasn't just found a new life in road cars. F1 cars have long been thought of as the peak of cool, and technology in them is also helping to cool down our produce aisles. Engineers from Williams are using their knowledge from 9 Constructors Championships, working with company Aerofoil to help reduce the energy consumption of supermarkets. The device they're building is based on the design of an F1 car's rear wing. It attaches to fridges to keep more cool air in the unit. They estimate it can reduce supermarket energy consumption by 25%. One innovation from F1 is also helping hybrids reduce their carbon footprint. That's KERS, or the Kinetic Energy Recovery System. In common parlance, it's known as regenerative braking and works by storing energy of the car decelerating in a battery for later use. If that's not enough, F1 is now looking at TERS, or a thermal energy recovery system, looking to harness the heat produced from braking and the engine exhaust. That could allow cars to generate the same power using 30% less fuel. So while F1 may have a reputation as a gas guzzler, some of its innovations in the name of speed are helping in the everyday fight against climate change.
Somebody says, I want to be, and a person has an impact on society, what would you recommend that somebody do to work their way up?
Well, I think the first thing, you've got to believe in something that you really care about.
That off with our dual mandate with full employment, and trying to navigate that to bring inflation down while we do so as